you provide a platform which allows investors to lend directly to, say, small businesses, consumers. We've been doing better and better because we have a very diverse range of different funding sources. So in some circumstances, I don't know, making out like some retail investors might decide to lend less, but then you have government, you have institutions, you have funds that can lend more. But liquidity is incredibly important because basically we don't actually lend any money ourselves. We actually just provide this technology platform.
But that's what makes you so different from a bank.
Exactly. So, we have this aspiration to do $100 billion of lending per year. And we should do over $2 billion this year. So we need to grow 50x to kind of get to that kind of level. If we were a bank that wanted to do $100 billion a year, our balance sheet we would need to have 10 to 20 billion of equity. If you wanted to kind of keep doing that each year. At Funding Circle, we need to have no balance sheet because ultimately we're matching up capital that wants to find better returns and productive uses of that capital, so small businesses and investors. And that's a much more efficient model. It's a much more efficient middleman than the banking system.
Right, in January and February of this year, Funding Circle originated or arranged more loans for small and medium-sized businesses in the UK than I think the 20 largest high street banks in the UK put together, which is pretty extraordinary when you think about a 6 or 7 year old platform going up against the traditional banks. Talk to us just about the momentum and how do you manage that level of volume?
So it's definitely a challenge, and actually, what I say to people is we're not actually constrained by the number of borrowers that want to get loans or the number of investors or the amount of money to invest. We have surpluses on both sides. Our biggest constraint is our ability to operationally scale the business, and we've chosen not to grow it too fast. We've chosen a level which is still very quick, but one which we feel comfortable with and that we can generate good outcomes for our customers.
One of the concerns that has come up on peer-to-peer lending is that because you don't use your balance sheet, which is the innovation in the model, there might be a flip side to that coin, is that you don't have skin in the game, and therefore perhaps you won't manage the risk as well because platforms like Funding Circle will be more keen on grabbing volume. How do you respond to that concern that flares up now and then?
I think it's a commonly raised concern, and we also, see behind the scenes a lot of bank lobbying to increase capital requirements on platforms like ours, and that's the way you kill this kind of industry, is you create capital requirements. Because a platform like Funding Circle makes about 3% a year off the loans available. So we don't actually make enough money to hold 5% of the loans on our balance sheet.
So if regulators asked you to set aside capital the way banks do, that would just turn the economics upside down.
Yeah, it just destroys the entire model. And the way I think about it is, in the crisis, people held 5%, 10%. Those things are irrelevant. I kind of think you need to go one way or the other. You either say you're a balance sheet, you keep the risk on there, or you say you're a platform and you have no balance sheet. So what regulators could do is they could say, you guys aren't allowed to actually lend on any loans. And that offers exactly the same incentives, and that's the model we've stuck to. If we don't produce good quality loans, people will stop buying them. Institutions, government, we publish every loan we do every single day. The effects would be very, very quick and dramatic. So actually, by sticking to the platform model, we're completely aligned with investors. It's almost the reverse side of the same argument. And I think that's the thing that I think regulators, and to their credit, every regulator I've spoken to gets it and agrees, is actually, if you want to have this very efficient intermediation tool, people don't say to the London Stock Exchange, you've got to hold 5% of every IPO that goes through. People don't say to BlackRock, you've got to hold 5% of every fund that you do.
So your model is much more akin to an exchange than it is to a bank.
Yeah, an exchange or an asset manager, I would say, than a bank. the same kind of concept applies, which is we're not actually putting the loans or the equity or stuff on our balance sheet. We're providing a very efficient way of matching capital.
And what is the average return to investors, say, on, I don't know, what would be a good vintage of loans to look at?
I mean, we have returned an average of about 6.5% to 7% a year since 2010 in our UK business, and pretty similar kind of levels in our US business. Investors have earned about 120 million pounds of net interest. So again, the model is becoming increasingly proven out. Every single loan we do, we aggregate more and more data. We get better and better at credit assessment. We actually listed a company on the London Stock Exchange, which is the first time that's ever been done, which buys loans from Funding Circle. And that's bought by institutional equity managers. It's got a market cap of about 310 million pounds.
Right.
And you're starting to see these kind of and some of the holders of that are people like the British Railway Pension Scheme, BlackRock. So you're starting to see very traditional asset managers actually look at these levels of returns and say, we want to get involved in this. We want a part of it.
I guess that kind of goes to the resilience of the model if increasingly it's emerging as truly a new asset class.
Yeah, exactly. I mean, traditionally what's happened, especially in small business lending. So in consumer lending, you've had credit card companies, supermarkets in the UK. Lots of people do that kind of lending. In small business lending, the only choice you really have is 4 or 5 banks, typically. And what they have done for a number of years is they've had this entire asset class to themselves because the data in small business lending, credit bureau scores aren't actually very predictive. So you just need to do lending to get the data to be able to do this. Mm-hmm. Whereas what we're doing now is we're opening it up as an asset class. You can come in. I used to say you can lend as little as £20 on our site. You can actually buy a share in our investment trust for as little as £1 now, and get access to this asset class that was previously only available to banks.
And don't the banks now have to share their lending data with platforms like yours?
Well, the big innovation that's happening in Europe, which I'm sure has been talked about a lot here, is this PSD2, where banks have to provide API access into current accounts. And what that means
is the brave new world of open banking that's coming.
Open banking, yeah.
Right.
Which really means banks become utilities, to be honest, providing the backbone, and you're going to have a lot of different services built on top. And once you have seamless access to current account data, to be honest, you take away the only advantage banks really had. People sometimes talk about, there's a cost of capital advantage, banks can get really cheap deposits. Well, they can, but the capital requirements are super high. And actually, we have banks that buy loans through our platform. So what's better than being a bank is having a bank buying through a platform and not needing to have any of the regulation.
One of the big themes that continually comes up in the fintech story is this idea of collaboration between banks and startups. But, I mean, Samir, from the get-go, you've really been out to get the banks, right?
I mean, I think we've kind of all grown up on both sides. I mean, we used to print these big posters saying, no thanks banks, and
right.
Take out adverts in the papers and all that kind of stuff. And I think there's been a recognition on our side that, I think we will be a very big part of the market, but you're still going to have banks. You'll always have people that want that kind of way of doing things, just like people always want to go to physical stores or things like that. I think there's also been an acceptance on the bank side that we are doing something very innovative. We can bring a lot to the table. And so you are seeing increasingly a lot of partnerships. I think we draw the line probably a bit closer to us than others in that we're quite happy to do co-branded relationships. We're quite happy for banks to buy loans through our platform. We're quite happy for referrals to take place. But we're not doing any of this white label stuff or the idea of becoming just a back end.
You don't want to be an adjunct of the banks in any kind of way.
No, and I think what you'll increasingly see is you will see a lot of banks purchasing loans through platforms like us because they don't have to have the acquisition costs. They don't have to worry about the collections, all that kind of stuff. We service the loans. We do the whole process. And you see it a lot in the US, and I think you're going to see it a lot in Europe, actually, where when you have a more fragmented system with lots of community banks, actually there's a huge advantage to them. Like if you look at something like a lending club, I think it was something like 40% of their volume was purchased by banks last
that much, really?
last quarter.
Okay.
Yeah, so it's quite a lot. And part of the reason for that is, that means the bank in Texas can compete with Wells Fargo because they can leverage this platform with all its data. So certain markets like the UK, Netherlands, where you've got a concentrated banking system,
right,
I don't expect to see much of that. Places like Germany, Spain, Italy, where the system is much more fragmented, I think you'll see a similar effect to the US, actually.
It's interesting that in the UK, the British Business Bank has put, £100 million or more on your platform to go out to small and medium-sized businesses, using it as a conduit, as an alternative to the existing banking system. We've seen the very week of Brexit, so that would have been almost a week ago this year, the European Investment Fund provided £100 million to Funding Circle to lend to small and medium-sized British businesses. So clearly, policymakers have identified peer-to-peer platforms as a way to get money on the street pretty efficiently.
Yeah, and we've been the most active platform globally in courting government. So the German State Development Bank, KfW, is also a lender through our platform as well. So we've got numerous government entities that lend. And it kind of goes back to this, partly why we started the business. And if you look at small business lending, say you've got a market like the UK, it's probably about £70 billion lent each year, which sounds like a big number. But actually, if you look at, say, the balance sheet of Barclays alone, that's like a £1 trillion balance sheet.
Mm-hmm.
So actually, small business lending, and all these banks have about 20% market share, and they kind of divvy it up between them. So actually, small business lending is a small part of bank lending, and they don't really care about it that much. Whereas it's actually a really big part of the economy. So small businesses typically make up 50% of private sector GDP, a higher percentage of employment. So it's actually a really big thing for society that we have money flowing to these businesses so they can expand. Mm-hmm. And what you typically see in a crisis, and obviously we're in the long hangover of the last crisis, is that banks typically restrict money at a time when actually you want to be stimulating small businesses. You want to be putting more money into the economy. Someone was telling me the other day that there's a perfect correlation between bank loan loss provisions, inverse correlation between bank loan loss provisions and marketing budgets. So when they start seeing higher losses, they just literally pull back. They stop doing marketing. They pull back. So what was really exciting after the Brexit vote was the British government actually put more money to lend through Funding Circle. They gave an additional £40 million. We've been talking about a lot more. So this speaks to the kind of resilience thing we talked about. Is I actually expect in a downturn governments to want to put more money through these platforms. And the final thing we really need to get done is getting small business loans allowed as an asset in quantitative easing, because that's the final step for what's better than a government stimulating directly. It's a central bank, the Bank of England, the ECB. You can go directly through a platform, stimulate the real economy in a very transparent, efficient way.
Have you talked to the Bank of England about this?
I've talked to Mark Carney many times, and I keep asking him, and eventually it will happen.
What does he say?
He says it's a good idea. When you guys get a bit bigger, then
when you get a bit bigger. Yeah, okay, well you're working on that.
Yeah.
What happens to your loan portfolio in the event of a crisis, say like 2008?
Yeah, so in a downturn, losses on SME credit increase. We have done a lot of stress testing work on this. My chief risk officer used to be chief risk officer of Barclaycard, so managed their £40 billion portfolio globally and actually managed it through the recession. And our expectation is that losses would double in a 2008 scenario. Now, the actual default rate would increase a little bit more, but because loans amortize, so they always pay down, you actually get hit on a declining balance. So suffice to say, losses go from what they are at the moment, which is in the UK about 2% a year, to something like 4% a year. Now, actually, investors typically earn an interest rate of about 10% a year, and we take a 1% fee on that side. So the net return an investor gets would drop from 7% a year to 5% a year.
Okay.
So they would get lower returns.
Right.
This is our expectation. We'll see what actually happens. Now, getting 5% a year in a downturn like 2008, when stock markets are going down 35%, corporate bond indices are very volatile, even government bonds typically decline as well, will actually prove, I'd hope, to be a good result. And my hope is that actually a recession or a downturn will be the making of these businesses, because we will prove the last thing, which is that we can make money for investors regardless of the economic cycle.
Okay.
And when we do that, I think you're going to see an explosion, because first of all, you're going to see platforms expand even more when banks pull back, because we're able to do that. We'll work with government to do that. And you'll also show that we can provide resilience to investors, which is the last thing. But the smart investors, as I said, these pension funds, large equity funds, insurers, they are already lending because they see this in the data. They can see there is very strong loss coverage in these loans, and they actually think they can make money regardless of the cycle.
Okay. Well, if hopefully there will never be another 2008 crisis, but if indeed the scenario you sketch out comes to pass, I think you'll have settled the resilience question once and for all.
Yeah.
Everyone, please give a hand to Samir Desai, CEO and co-founder of Funding Circle. Thank you so much for joining us.
Thank
Cheers.
you. Cheers.
Ladies and gentlemen, center stage will now break for lunch. Content will resume at 1:45. Please make sure to get a seat in time.
See it for you. See it for you.
gentlemen, please welcome to the stage Data Science Associate for MoneyConf and Web Summit, Sarah Massicot.
All right, guys, I'm going to make this quick. Welcome back to the final afternoon of the center stage at MoneyConf 2017. We're going to have some very, very exciting speakers this afternoon. We're going to have blockchain, DBS, MasterCard, Adam Bank, Creditech, HSBC, BBVA, and a few more. And we're also going to have our world-famous pitch final that's going to be held here at 2:40. And that's when we're going to see this year's finalists battle it out to be crowned the winner of Pitch at MoneyConf 2017. But first off, we're going to be asking the question, can Bitcoin really reach $500 million in value over the next few years? So let's see what's possible in finance's digital future. And please help me give a very warm welcome to Oscar Williams-Groth, that's going to be in conversation with the co-founder and CEO of blockchain, Peter Smith.
We are here with Peter Smith, who is the founder of blockchain.
No, wow, I have amazing audio. This is a rare privilege. I have a journalist who can't talk. It's just me, so I'll do my own introduction. My name is Peter. I'm the CEO and co-founder of a company called Blockchain. We got started 4 or 5 years ago with the simple idea that we'd make it possible to use digital currencies for sort of average, everyday consumers. And then Oscar writes for Business Insider, covering the fintech space in London.
Thank you there.
You're welcome.
Yeah. So we're here to talk about Bitcoin. So a good place to start. This is something you wrote, Peter, for TechCrunch in December. The headline is, blockchain technologies entered the trough of disillusionment in 2016, but 2017 will be brighter. So you were right.
Yeah, I think it's dangerous to make predictions. But in this case, if you make them vague and general enough, you've got at least a 50-50 shot. And it looked like I got on the right side of the 50-50 split this time.
And I just had a quick look at the price before we came on stage. I think we're around $2,800 per Bitcoin. I think when you were writing that, it was around $970, maybe, something like that. So it's more than doubled since the start of the year. What's driving the price?
Yeah, and I think it's interesting to think about the sort of market cap of the space overall, of sort of all digital assets in the space, so currencies, tokens. It's gone from about 30 billion to about 104 billion today. So it's been quite a dramatic rise across the whole sector, and obviously a huge rise in Bitcoin specifically. I think a lot of things are driving it. There's certainly a great deal of momentum. I think one of the things that can't be ignored is some regulatory clarity that's emerged in both Russia and Japan, which are two very large markets, which the market received very positively. And then I think that globally there's a lot of macroeconomic uncertainty. So in a lot of markets that are really key for us, we see growth go up a lot when we see macro instability go up as well. And we're seeing that in all kinds of key markets across the world today. So I think it's a lot of things driving the price. And not the least of which, of course, is momentum.
And in terms of the sort of macro picture, I mean, we spoke last year just after Trump was elected, and you said that's pushed you guys to a record month, and I think you passed sort of 10 million wallets downloaded. Has that sort of continued? Are you still seeing that sort of
Yeah, so actually
bump?
it's pretty crazy. In the last 8 weeks, we've seen traffic across our platform grow by about 170%.
Wow.
Which is, if you back the numbers out, over 15% week over week. And I think people are usually looking for 3 or 4% month over month. And so the last quarter has been particularly amazing. That quarter was really strong that you and I talked about, but it now looks quite pathetic up against last quarter. And so growth has been really strong. And what's been good to see is that we're seeing growth, of course, in the price, but we're also seeing growth in sort of the fundamental activity level across the ecosystem, which makes it very different from some of the previous price run-ups that we've seen in the past.
And just returning to the price, Mark Cuban yesterday caused a bit of a bump in the price because he said it was a bubble. I mean, do you think there is an element of overhype in the price at the moment, or do you think it's justified?
Look, a price is justified by whatever someone else will pay you for something. And so from a classical economics perspective, I think as long as trades are still happening, the price is justified. You could have a debate about volume. I think if I were to comment specifically every time a celebrity made a comment about Bitcoin, I'd probably have a different full-time job.
And beyond the price, there's still some debate around the underlying network. So we've got the whole sort of SegWit versus Bitcoin Unlimited debate. What do you sort of think about those issues? Are they going to sort of work themselves out fairly naturally?
I think that they'll work themselves out at an industry level one way or the other. And what we'll see happen is we'll see companies route around that problem, either by adopting other digital currencies, which we've seen happen to a certain extent already, as Bitcoin's sort of total dominance of the market cap has fallen. So you've seen people route around that way. You'll also see them route around it by building sort of off-protocol systems. And there's been a lot of research and talk about that. At the same time, I think that for the first time actually ever, there's tremendous consensus across the entire industry about a series of protocol upgrades that are slated to occur in a couple of months. And so I expect to see it solved on a lot of levels, whether it's by routing around the Bitcoin protocol, going to other protocols, whether it's about layering new solutions on top of the Bitcoin protocol, or whether it's about upgrading the protocol itself. I think that the industry will route around the issue.
And we heard this morning from people like David Rutter of R3, and he was sort of talking about building these sort of separate solutions, custom-made for banks and these sort of things. But Fred Wilson, the sort of noted VC, he said that banks are ignoring the potential of Bitcoin and the blockchain by trying to do these sort of private, closed chains. Do you agree?
So I think I have 3 points here. The first one is that I generally try not to judge tech companies until they put a product out. And R3 hasn't put a product out yet. So I can't really say much about them. I think that Fred is probably right, in the sense that when I talk to bank CEOs, they usually come to me and say, hey, can you make the clearing of equities post-trade more efficient or faster? And I could. I feel like we have the technology, we have the people to do that. The thing is, I'm not sure I'd use a distributed ledger, first of all. And it's also a really uninteresting question, because there's people out there in the world today that are working on reinventing the actual product. And the actual product is helping companies raise capital, right? And so this, people are working on this sort of frontier as the ICO or tokenization space. That is a 500 to 1,000x improvement in how companies raise capital. There's a great post by Naval Ravikant about this, where it's a 500 to 1,000x improvement. That's the kind of innovation that I'm interested in being a part of, that I'm interested in investing our resources in, not making step 9 of a 13-step process more efficient for a global investment bank that probably hasn't been delivering fundamental value to its customers for a very long time. The third thing that I'll say about this space in general is that I think that people on both sides of the aisle are right, that the future is probably not going to look as radical as Fred or Naval think it will, and it's probably also not going to look as incumbent-dominated as some of the people building private blockchains, whether you're talking about IBM or R3, think either. The reality is it's probably going to end up somewhere in the middle, where people build great products using much better technology in a way that global regulators can get comfortable with on a consumer protection front. That sort of philosophy is what you've seen in a lot of our products. And I think that in the end, that's a philosophy that will win out over a long curve.
And you obviously talk regularly to a lot of the big banks. Has the conversation moved on much over the last sort of 6 months to a year, or are they fairly still?
Well, the interesting thing that we've seen happen on the global banking level is that there was sort of this wave where it was like, okay, let's take this and take the tokens or the currency out of it. We don't like that part, it's scary. And then they gave up on that. And so a lot of the big projects now you'll see, whether it's UBS or Deutsche or Goldman, have recognized the need for a currency on these blockchains, right? My thesis is that the next wave of realizations, which is happening right now, is banks realizing that actually it's probably more innovative to be on at least a semi-public network, right? And so I think that the next wave of sort of like acceptance on the part of incumbent FIs is accepting that they need to be on at least a semi-private network, if not a totally public network. And by the way, over the long curve of history, every time technology comes into a space, everything usually ends up on a vast public network. And so it's quite funny to think that this would be the one exception, which I just don't think it will be.
And you mentioned the sort of boom we've seen recently in initial coin offerings. Why have they suddenly become so hot? Why do you think people are turning to them now?
So I think it's about pent-up capital. So if you think about our space, we have 80, 90 billion of capital in our space. Capital by its very nature wants to work. It wants to be invested, right? And people in our space are particularly passionate about the space that they're holding capital in, right? And so when they see projects that they could invest in, but also be part of something innovative and something revolutionary, I think people have a strong demand for that. A great example is a company called Brave, which is VC-backed, Greylock, et cetera. And they decided to do an ICO for their next raise. They raised about $35 million in 24 seconds. Wow. Which is a lot faster than when I raised the same amount of money from venture capitalists by about 1 million times. And so, that project, people are so passionate about it because it's delivering on something that a lot of people are really excited about, which is seeing micropayments, paid content, a cleaning up of the internet. And so there's a lot of pent-up capital. There's a lot of passion for the products in the space. That's fueling a lot of the ICO trend. I think it's easy, by the way, to look at the ICO space right now and say, oh my God, there's so much shit, right? And there's a lot of shit in that space. But that's pretty much how everything starts. The first version of anything isn't really awesome. The first time Nike tried to build a pair of shoes, they were nothing like the Nikes I'm wearing today. And so I think with the ICO space, you have to recognize the innovation, but also buckle in for a long period of time before you really hit the kind of stuff that you're looking to see.
Do you think it'll evolve a little bit like we've seen with the sort of crowdfunding space? More?
I think that there'll be a big difference, which is that there's actually, number one, capital, which crowdfunding has never attracted the kind of capital you need to make that work. And number two, efficient ability to aggregate the capital. The thing that's held back a lot of crowdfunding sites is that it's incredibly expensive for them to take tiny sums of money and aggregate them because of existing payments infrastructure. They also can't do it across the entire world. One of the things that makes ICOs so interesting is that for a tiny cost, you can aggregate huge sums of capital from anywhere in the world in 24 seconds.
And I'm conscious I haven't asked you about blockchain, your company itself. So tell me, what are you guys working on? Because I know you've always got such interesting stuff going on behind the scenes.
So we have a simple thing, which is that we don't talk about stuff we're working on
Worth a try.
Until you can use it.
Yeah.
And I think that's because of how I want us to be judged. I want us to be judged on the quality of our product, on the strength of our product. At a high level, though, we're working on a lot of next-generation assets. We're working on a lot of scaling stuff, so things that you would imagine. We're sponsoring research programs with top-tier universities around the world. And then on a consumer front, we're adding 30, 40% to our user base every single month right now, which is its own challenge to deal with. We have millions and millions of active users across 100 countries around the world, and we're systematically trying to support all of those zones. And we're trying to bring enhanced liquidity to markets in about 42 countries now.
Wow, so you got your hands full.
Yeah, I keep busy every now and then.
And where's that growth in the user base coming from? Is it new markets, going deeper into existing markets?
It's existing markets because we've been almost everywhere for quite some time.
Yeah.
And by the way, like to achieve 20 to 30% growth on, last month we did several billion in volume. Like that means to achieve 20, 30% growth, I need to add $500 million in volume. There are very few fintech companies that are not public that are even doing $500 million in volume. And to answer your question, more clearly, about 80% of our user base is outside the U.S. Europe's also pretty big for us, but sort of the global markets are really where we play.
And you guys hit the headlines early last year. Was it earlier this year? Anthony Jenkins, the former Barclays CEO, joined your board. What was it that attracted him, and how did you guys connect?
So Anthony and I met at a dinner in London, and we sat next to each other, and we sort of instantly connected over how we saw the world changing. I really wanted to bring someone on board that understood what it was like to run a very global, very complex financial services company. Obviously, Barclays is a very global, complex financial services company. And he had a real passion for actual individual consumers that I don't see in a lot of bankers. And I think it's because he came from the commercial and consumer side rather than the investment banking side. And so it was that I really loved about him. When I called my board and said, look, I really like this guy, I think we should add him to our board, they said, well, you can spend time on this, but you should think about it as a moonshot because there is no former top 5 bank CEO on the board of a startup. And if they start doing that, I highly doubt it's with a digital currency startup. And I was like, well, let me work on it. And to his credit, like he's somebody who really wants to push the envelope, who really wants to do interesting things, and wants to be at the forefront of the evolution of technology. And he's been a great board member.
So how long did you have to work on him then?
It's a lot like dating. It takes me about 6 to 9 months to get a date, and it takes me about 6 to 9 months to add a new board member.
Okay. Obviously this panel is titled, Bitcoin Billions. Where do you see the price of Bitcoin, first of all, ending up end of 2017, and then where do you see it going more longer term?
I want to be very clear about being on the record on this. I have no idea where the price of Bitcoin will be at the end of 2017. I will say that I have bought Bitcoins every year for the last, it must be like 6 or 7 years now. I am on the record predicting that Bitcoins could hit $500,000 a Bitcoin. But I think I said that that could happen by 2025. Okay. So I've given myself quite a lot of time to work on that goal.
Yeah.
But I really have no idea in the short term where we're going.
Yeah. And you still stand by that half a million, is it? Mm-hmm. Yeah.
Yeah, I think there's about a 50% chance that an individual Bitcoin will be trading somewhere in that range by 2025. Who knows, though?
And how big a driver is China on the price still?
China's a big global market, both really on anything and also in our space. So there was a lot of press about a year ago that said like 93% of the Bitcoin market was in China. Found that fascinating because we weren't seeing it. And what it should have read actually is 93% of self-reported exchange volume is in China. And then the Chinese regulator came in, the PBOC, and cleaned up the exchange space in China, sort of made people stop self-reporting volume and only report their actual volume. And they went from being about 93% to 16%, which is what we were seeing. And I really wanted to send an email to every journalist that had ever called me to ask me how I felt about 93% of Bitcoin activity being in China. But then our comms team intervened and I wasn't allowed.
So where, if you say that's not what you're seeing, where do you see it? Is it a fairly even spread across the board?
It's really global.
Yeah.
I think the US is a big chunk. Europe's a big chunk. China's an equally big chunk. And then, it sort of goes downhill from there where you have, Brazil's huge. Argentina's really big. The former Russian Republic is really big. And so it's really varied.
And obviously we saw the SEC reject this application for a Bitcoin sort of ETF. Do you think it's going to remain sort of outside the mainstream, or do you think they'll eventually come around and Bitcoin will find its way into more sort of institutional pockets?
Well, I mean, I think that it's pretty mainstream already. Like in the US, you can, link your Fidelity account to your Bitcoin account now. CME Group prices it, Bloomberg prices it. An ETF is going to be interesting when that happens. And actually, there's similar products already in the UK, sponsored by Hargraves, which just came out 2 weeks ago. But the ETF, I think, will happen sometime this year. That first application, they wanted to be the market, the pricer, and the custodian. And usually, you can only be one of those things. Okay. And so I think we'll see some of the later applications be successful. But, who knows?
Well, Peter, unfortunately, that's all we've got time for. But thank you very much for being here and talking to us. And thank you very much for listening.
Thank you.
The world is not an equal place. Most of us in this room take for granted all the financial products and services we use every day. But there's a significant portion of the world that don't have access to fairly priced products. So what's the key to turning this around? Is it purely digital, or is it going to require a societal shift? So to try and answer this, we're going to be joined by the senior editor of Zoete Deutsche Zeitung, Andrea Rexter, and she's going to be in conversation with self-proclaimed champion of innovation, diversity and inclusion, the President International of MasterCard, Anne Carnes.
So thank you for welcoming us. Thank you, Anne, for joining us. Anne is President International for MasterCard. In that position, she's responsible for the management of all countries outside the US and Canada. And the really exciting part of her career was in the beginning. After her graduation from university, she was an award-winning engineer, and she was the first woman working offshore in Britain. And what happened then? Then suddenly you decided that you want to go inside the boring banking system. What happened?
No, well, British Gas privatized the company that I was working for, and I could see that the people taking over the company seemed to have a lot of financial acumen. So I thought, maybe I've got the wrong training. I should go and retrain as a banker. So that's what happened.
That's what happened. Then you worked for Citigroup. After you worked for Alvarez and Marsal in London, managing the Lehman business right after the financial crisis, which must have been a very exciting period for you in your career. Mm-hmm. And you also had high positions with ABN AMRO. So, but Anne, what we are talking about right here on stage is financial inclusion. You're very passionate about that topic. But if you look at the industry as a whole, how good or how successful have you been so far in including those on the lowest rung?
I think the industry's been pretty successful. Certainly the World Bank has produced stats that said since 2011, an extra 500 million people have been included in the financial system. And I actually think those stats are out of date now, so it's probably bigger than that today. So I think there's been quite a global push for this, and it's been pushed by governments and NGOs and many different partnerships.
Mm-hmm. But doesn't access alone miss the point? Isn't the real problem that those people have is that they don't have money?
I don't think that people necessarily don't have money. I think they don't necessarily have money inside the financial system. I mean, even if you look at different parts of Africa and India and so on, you know, people are farmers, they're growing things, they're selling their goods, but they have no means of being paid electronically. So it's not a question of not having money, or it's not a question of not having work. It's just, is it inside the system? And on the subject of access, by the way, I think education's really important. When we created MasterCard, we put 10% of our stock into a foundation at that time, which was our stock was worth 5 billion, so we put $500 million into the foundation. Today, our stock is our market cap is worth about 136 billion. So our foundation is, over 13 billion, which makes it one of the biggest in the world, and that focuses on education as well as microfinance and so on. I think you have to have education and inclusion, because if you have access without education, it's pretty dangerous. But if you have education with access, that's totally pointless. So those two things are really needed to create a better world.
It does create maybe a better world, but it also does expand the business of MasterCard, doesn't it?
Well, absolutely. I mean, we talk about this quite a lot to say, look, we're in the business of connecting up consumers, giving them financial products that can link them to the banking system, working through banks or working through governments or working through retailers and different organizations. And so it absolutely fits with our business model that we include more people in the financial system. But if you think about that, instead of just having a pure philanthropic view of it, we actually have a sustainable business model that makes sense. So that says, even if the financial climate wasn't great and your business wasn't doing so great, you would still invest in it, because it actually is a strategic goal for the company to reach so many people. And I think that sustainability of business models is what really drives things to be successful. You shouldn't have people waiting to see whether you're going to be philanthropic tomorrow or next week. It should be something that's good for all.
How important is technology for financial inclusion?
I think it's absolutely fundamental, because inclusion often starts with digital identity. You know that people are born all over the world and their births aren't registered. People don't have passports, they don't have driving licenses, particularly women. And so if you can give people a digital identity, that's a fantastic starting point. And that means things like linking their fingerprints to a chip, maybe their voice recognition, maybe their iris, whatever it is. Again, that fits very well with our business model. It then sort of moves into the developing world in terms of different forms of biometric authentication. So in the developed world, you're trying to maybe get more young people to adopt technology and financial inclusion, and so you move to something like selfie pay, because we're told that millennials take 5 selfies a day on average, which I was laughing and saying, at my age, you don't even want to photograph, never mind doing selfies all day. But selfie pay is a way of authenticating yourself, and it's fun, so it causes adoption.
But is technology really the only tool to get people financially included? Because the access to technology does also cost money, so there might be a gap between, for example, cities and the rural sphere. How can you...
Yeah. No, technology is just an enabler. The point you raised at the beginning was people have got to have money. Money's pretty fundamental. What we find is, in most countries in the world, the governments are giving their people money, either through benefits payments, it can be pension payments, it can be child allowance, all sorts of things. So often it starts with working with the government to say, you want to give the benefits, you want to give them to the right people in your economy. So let's get people digitally enabled so they can receive their benefits electronically. And in places like Kenya, we launched a whole Huduma card where people can pay the government. They can pay taxes and they can pay things like that from the card, and the government can pay the individual everything that they're entitled to in terms of their different benefits. So you create a two-way flow.
And how do you feel? How are you feeling to those who have excessive APR charges and thus perpetuating the circle of debt, especially when it comes to low-income families who struggle to break free from the circle?
Yeah, we talked about it. I think that in the case of the way that the financial system works, very few countries in the world, and remember that I look after about 210 countries, very few are credit-based economies. Mm-hmm. Credit-based economies tend to be markets like America, like Britain, and Australia. When you go into even most of Europe is a debit-based economy. A debit-based economy, you can't spend more than you have because money comes direct out of your bank account. And then in the emerging markets, it's much more of a prepaid economy. People are used to actually topping up their telephones before they use the minutes. That is a form of stored value. And that is what the financial system is moving to in those countries. And for example, a government giving a citizen a card or loading up their telephone with money for benefits, that's a prepayment. So I think that the regulators, the banks, the financial systems are looking at ways of avoiding, putting people into difficult situations in terms of debt.
You're not only passionate about financial inclusion, but also about gender. Does financial inclusion help women more than men?
It definitely does, because without doubt, women are more excluded than men in the financial system. And also, we work with different people in different parts of the world. And we have a lab in Africa that we funded with the Gates Foundation, and many of the farmers in Africa are actually women, but it's hard for them to sell their crops direct to the buyer. So we've actually launched a technology product that we're rolling out across Tanzania and parts of Kenya right now, where the women, well, not just women farmers, but all farmers can sell things like edible oil, sunflower oil, direct to the buyer through their telephone. And whether they've got a smartphone or whether they've got an Android phone, they can get the price of the oil 6 times a day. Imagine putting that power into the hands of farmers. The reason I bring that up in context of women is many of the farmers are women. And this will be the first time that they can actually receive money for their goods electronically, and actually allows them to sell at a price they want to sell at instead of having to negotiate with a middleman. All of these things can be achieved when you think about financial inclusion.
Mm. And when it comes to MasterCard as a company, seeing you here on stage could give one the impression that there is no such thing as a glass ceiling, because you're in the C-suite already. But have you ever experienced in your career a moment where you thought, okay, this happened to me because I'm a woman?
I think, there's been times in my career, like everybody's career, where you've been in the number 2 position and you want the top job, and you don't necessarily get the top job. Is that because you're a man or a woman? I don't know. But I do think sometimes it's easier to get a promotion if you move departments in your company, or you move companies, or you just do something different. And that's the thing that I've experienced in my career.
If you're talking about diversity, it's not only about men and women. It's also about different backgrounds. What does MasterCard do to encourage people from all kinds of backgrounds to engage with you?
Well, first of all, when I joined MasterCard a few years ago, many of our people had just come out of banks because we were owned by the banks. And so we were just predominantly bankers. And actually, we were quite an old company in the sense that, the average age was over 40 in our company. Now, today, we've got 36% millennials. Most people are Gen X, and I think about 11% baby boomers, so that includes me, obviously. And so completely different generational mix we've recruited around the world. And then we started saying, we need people to come in from governments, we need them from retail organizations, we need them from technology companies. So we actually changed the whole way that we recruited. Right now, we're an amazing mix because we're in 210 countries. So actually the diversity in terms of the different nationalities in the company is huge. But also we're 40% women, and we actually are 50-50 women at entry level. And what this means is because we develop products, we've got 2.3 billion products out there for consumers all over the world, that we are designing with people who are a mixture of young, old, different ethnicities, different genders. And so it gives us, a great team of diverse people to design the next thing for the future.
And what do you do to not lose those people at certain points of their career?
Yeah, well, that's a really interesting question because I think that's going to be the thing that companies have to solve more and more in the future. We have incredibly low attrition rates. There are only 12,000 people in MasterCard. Every month, 12,000 people apply for a job in MasterCard. We have 12 times the size of our company apply every year, and our attrition is single digits. Why? Because we're a growth industry. People love working here because we're building things that actually make sense for different economies, different cultures. There is a very high set of values here, which is what attracts, the millennials. But also we're introducing things. We know that people can't be promoted every year and so on and so forth. In fact, organizations are flattening. So what we try to do is move people across different functions around the company, and we move them from one country to another. So, we've got all sorts of schemes. So you're sitting in Britain, maybe you want to go and work in Mexico for 6 months. We make that happen. So, and all during my career, I switched, from being an engineer from a bank to a banker, from being a front office banker to running ops and technology, from being in investment banking to being in restructuring, from being in restructuring to being in MasterCard, which is a technology company. I think that's what people want out of their career. They want variety, and they want growth, and they want solving real-world problems today.
Mm-hmm. Let's talk, as the last question, a little bit about your visions for the future. Many in the industry, especially in fintech, think that the future will be completely cashless. Mm-hmm. Do you share that point of view?
I don't think that it will necessarily be completely cashless. I think that, we're a long way from that today. Middle East and Africa is 98% cash. Latin America is 91% cash. Germany is 60% cash. Actually, Europe is 76% cash. So there's a long way to go to, reach a completely cashless world. What I do see happening is, we're going to go to machine payments. I think the rate of electronic payments will accelerate. The rate of e-commerce is accelerating. And digital currencies, will come into play, are coming into play. There's Mint in Canada, which is a perfectly legitimate digital currency. Blockchain's going to be here, and it's going to probably be the mechanism that's used for to help world trade, move things around, because when you're in a trading environment, moving things from China to Europe or all over the world, so many different people touch that transaction that a single ledger solution is great. All of these things will happen, but I think they're going to happen at a different pace in different continents, and it will be, it will be an evolution, not a massive revolution.
And if you look at the surroundings right here, for example, we have a lot of fintechs and startup companies. What would you single out as the biggest challenge for MasterCard and its business model?
People have said to me, well, will the technology companies create a completely different business model from MasterCard? Yes, but the answer is we work with technology companies all over the world. Our business model is a network. We are an infrastructure player, and the more things that are connected to the network, the better things are. So we've been producing, new API layers and so on, so that we can work with the small digital players everywhere in the world. And obviously, we've been working with the big digital players like Apple, like Samsung, and so on, Amazon. And so actually, we believe that because we have that infrastructure play, we're in a strong position. And also, the other thing I'd say is building things in the digital world, you can do it very quickly. And one business model can replace another business model quite quickly. But if you think about how our network works, we're connected to 40 million physical endpoints today. You know, our goal is to be connected to 100 million physical endpoints, because people are still people and they move in the physical world. So it's the convergence of digital and physical that make the network strong. And it's playing with all of the ecosystem, the governments, the partners, the tech players, and make the network strong. And so I think that there's a strong future for MasterCard. So do the analysts, of course, and that's why you see the market cap.
So on a personal level, you didn't invest in any startup, but in MasterCard.
On a personal level, sorry, what?
Did you invest in a startup or rather in MasterCard?
Yeah, well, I'm definitely invested in MasterCard. I'm very vested in MasterCard, of course.
Okay, so thank you very much, Anne, for joining me here.
Okay, thank you.
Ladies and gentlemen, please welcome to the stage Head of Startups of MoneyConf and Web Summit, Paddy Griffith, and our pitch final judging panel. Ladies and gentlemen, please welcome to the stage Head of Startups of MoneyConf and Web Summit, Paddy Griffith, and our pitch final judging panel.
Good afternoon. My name's Paddy. I manage the startups here at MoneyConf and across all our events. So what we're going to do here now is the pitch final. Essentially, pitch is our international startup competition. From around 2,000 applications, engagements, and interactions with startups for this event, we selected 18 to pitch in the first round and semi-final of the competition yesterday, and we're going to have the finalists here at the moment. So the way it'll work, we're going to have 3 startups. They're each going to pitch for 4 minutes, and then there'll be 2.5 minutes Q&A with our judges here, who I'll introduce shortly. The announcement for the winner will be at around 3:50, and that's going to be fantastic. So I suppose just to introduce the judges. First up, an early growth stage fintech investor in both the US and Europe. Existing investments include Personal Capital, SumUp, Coinbase, DocuSign, Radius, Ribbit Capital, 500 Startups, and many more. So please welcome Managing Partner of Propel Venture Partners, Jay Reineman.
Bravo.
Next up, we have a leading fintech entrepreneur whose billion-dollar startup has provided over $3 billion in funding to more than 100,000 businesses in a little over 8 years. She is Cabbage co-founder and COO, Katrin Petralia. So give a round of welcome. And finally, we have an investor who manages the fintech investment practices across North America, Europe, and Asia of one of the world's largest e-commerce businesses. Please welcome Managing Partner of Rakuten Fintech Ventures, Oscar Miel. Okay, guys, so we're going to start the competition. Again, 4 minutes pitching, followed by 2.5 minutes Q&A. So first up, we're going to welcome Sylvain Forte from Seasum from Paris, France. They develop stock market analysis tools via machine learning and social media analysis and have already traded north of 25 million euros. So Sylvain, best of luck.
Thank you very much. Thank you for the presentation. It's a pretty big stage, pretty impressive. Thank you very much to everyone for being here. Yeah, I'm Sylvain Fortier. I'm the CEO of Seasum. We're a fintech company in the field of artificial intelligence and big data for asset management. We're working with hedge funds, banks, insurers, and pension funds. First, let's talk about big data. This is all about Seasum. We're really working in the big data sector. Let's try to find a pretty common definition of big data. Big data is often defined with 3 V's. Large volumes of data, a huge variety of data, which means structured data and unstructured data, not only numbers, but also text, videos, audios, and lastly, a question of velocity, real-time analysis. And if you actually closely look at these 3 V's, you realize that asset management is fundamentally a big data task. You have exactly the same 3 V's in asset management as you have for every kind of big data task. So the real question is here, how to use big data and artificial intelligence to gain an edge in financial markets? Pretty big question, eh? A very big question. We're not able to solve this whole problem, but we can address a few very specific problems with our own technologies. And we have 2 specific aspects that we address. One is we concentrate on text. We analyze in real time data from more than 120,000 different textual data sources. News, forums, blogs, social media, social trading platform. It's on a very, very large scale. And the second thing is we have to extract smart data from this information. We have to be able to compute numerical data from it. And we concentrate on finding numerical data for sentiment, emotions, and opinions. And based on this, we can actually do many different things. Our process is the following. We extract this data, we analyze emotion, sentiment, opinion, and the goal is to provide added value for asset managers. So we actually provide them with trading signals, investment signal that they can use. We have currently hedge funds clients investing in real time $25 million based on these trading strategy based on emotions analysis. And on the other side, for financial institutions who really want to get access to the underlying data and build their own models, we have a platform that is called L'Humeur des Marchés, where it's possible to access a very, very large scale of different data sources. We can get access to more than 10,000 different financial assets, forex, equity, commodities, etc., and analyze in real time what's happening on these different platforms that we are analyzing. A few words about the company itself. We are currently, as I mentioned before, a team of 15 people, experts in their field in both artificial intelligence and quantitative analysis, and growing very, very fast right now. We have cutting-edge technology in what's called natural language processing, analyzing text, but also in quantitative analysis, which is building trading strategy, building investment indicators based on this data. And lastly, in terms of financial, that's also the goal in a company like ours, we raised €1 million last year during our seed round. We are finishing right now a Series A of €2.6 million to be able to continue to scale the business. And we already signed for this year 800,000 in revenue. So the growth has been really good right now. Our indicators has proven that there is alpha, there is performance to extract from unstructured alternative data, and we hope to bring it to the whole financial world.
Great.
Thank you very much.
Cheers. Thanks a million, Stephen. Judges, over to you, Jay. Want to kick off?
Could you tell us a little bit more about the asset manager that's currently using the product? And what's the KPIs that they're looking for to, is this a pilot or is this how are they paying for it?
These are not pilots anymore. We are mostly dealing with hedge funds directly. I won't name them on stage. That's pretty confidential information. But we have clients in Hong Kong, in Singapore, in the UK, and in France. They are using our indicators as part of their trading strategies. Again, I cannot exactly name the performance, but our clients have massively outperformed indices and hedge fund benchmarks over the last 2.5 years of live trading. So we are way over what happens in the classical industry in terms of what is possible with fundamental and quantitative analysis. So the data brings value, we can prove it.
Is there an integration process with them, or do they use your interface?
Yeah. For what we call the premium data stream, which means algorithmic trading signal, the integration process is pretty long. We have to build together the strategy that they want to really integrate it as part of the automatic, systematic investment process. For l'humeur des marchés, it's very different mood of the market, the platform. It's an entirely open platform, so they can get access to the raw data and do whatever they want with it. Integrate it in a data lake or take a look at the front visualization platform, extract the data, perform statistical tests. So it really depends on the kind of clients, the type of problem that they want to solve.
So you said major overperformance.
Yes.
What's the alpha? And also, what's the revenue model? Are you selling this as a SaaS? Do you take a cut of the returns, make big fees?
When we generate trading signals, trading strategies with systematic hedge funds, we take a cut of the performance of the returns directly. For l'humeur des marchés, it's a bit different. Because the platform is open, it's indeed a software as a service product. So they get access to the platform, they can extract the data, but they do not have access to the predictive models to go further and directly go to the alpha generation.
So you don't make money on that?
We do, but on a SaaS model, so it's a bit different. It's much more scalable than specific projects, specific indicators, but it's also less value that is directly brought to the asset manager. He has to build his own strategy based on it.
Guys, we'll leave it there. Thanks a million, Stephen.
Thank you very much.
Round of applause. All right, so that's it for our first pitch finalist. Next on stage, pitch finalist number 2, joining us from Belgium, it's Matthew van Niekerk from Settlement. Settlement focuses on the skill gap of corporates incorporating blockchain technology, as well as the complexities of the technology itself. So let's all welcome Matthew on stage.
My name is Matthew van Niekerk, and I'm the CEO and founder of Settlement. Settlement is, I'm excited to be here today. This is the first time that I'm publicly announcing what Settlement has been busy with for about the last 18 months. We've been busy building software development tools for developers to build blockchain-based applications. We're making blockchain applications and their development accessible to every developer. I won't give too much of an introduction to blockchain technologies. I suppose here at this event and with this audience, it's enough knowledge is already gained about what this technology is. Suffice to say that it's going to change the world, and it's starting already. So what does Settlement do? With that as a backdrop, as a context, Settlement essentially bridges the gap between enterprise developers, enterprise developers, developers in an organization, or individual startups that have a company that they think they can build a better product using blockchain technologies. What we do is we bridge the gap between the existing skill level and the blockchain technologies that lie deep underneath the distributed ledger technologies. So looking a little bit at typical application architecture, what happens above the surface, that's the user interface, the different apps or web-based applications that companies build. They want to focus on improving their user experience. And what we do, our product offering, is everything below the surface, going from a set of SDKs and APIs to core components that are required and come back every time and again when you're building a blockchain-based application, such as how to manage key storage and how to work with systems like IPFS. So what we've looking at about probably 800 or 900 different use cases over the past 3 years. We've built 4 different functionalities, functional requirements that go across industries, across applications, across use cases. These are notary, provenance, ballot box, and marketplaces. The notary function, I'll just dig a little bit deeper on that one. That's, for instance, if you want to issue a birth certificate, a driver's license, if you want to issue your land title on a blockchain-based solution, or if you just want to register a document. This is a notarization function that we've encapsulated in an SDK. Essentially what that does, what does that mean in normal talk, I suppose? 8 lines of code, and you've got an API connection, plus all the plumbing you need to start notarizing documents the next day. Provenance is more for supply chain management, but also very relevant for things like ownership of financial products, assets, issuance through the life cycle of a product. That one can be used for building financial products and applications there. Ballot boxes for voting. That offers for either government elections, but also things like shareholder voting and proxy voting. Marketplaces, that's you want to buy a thing, buy, sell. That's essentially what it is. That's smart contract is a key component within that. So more than idle talk, we built 5 applications already. Our current phase of what we're doing, we're building up proof of concept projects for different companies that are asking us to build certain things. Data broker is a very exciting vertical on its own. That's essentially eBay for sensor data. In the context of a smart city, it's a very compelling offer. I'm pitching that to smart city initiatives around the world. The HR8 system is an internal governance system for passing legislation. Voting, we ran a parallel election to the US election back in November. Let the world vote on who should be the US president. Identiment is KYC, and the notary is for contracts. Our revenue model at the moment is based on bespoke work. As we transition into bespoke work, as we transition into licensing and commercializing our core technology, that'll be driven by license and transaction fees. Where are we today? We've got a presence in the Middle East with a value-added reseller called Ation. In Europe, we take care of most of it. In the US, with a company called Medici, an investment firm called Medici. They were our seed round investors. And we're looking to raise capital in Q3 this year, looking to raise between 5 and 7 million to launch our product commercially. Last thing, team. We've got 10 at the moment. Myself, about 12 years experience in financial services. And my co-founder, Roderick, has been the CTO of a company managing a team of developers of about 35 guys. We started the company incorporated in August, but of course we were busy for quite some time before that in parallel to our regular jobs. We're hiring and growing as well. So.
All right, Matthew, thanks a million. We'll kick off the questions. Catherine, do you want to kick off?
So what percentage of the implementations would you say are going to require consulting from you versus they can just read the documentation and integrate out of the box?
Yeah, I would say probably that'll evolve over time. I think in the early phases there will be a lot more need to do educational work at first. One of the things I didn't mention on our revenue curve, our revenue source, is the academy that we run. So we're already doing trainings in Belgium. We have one in Dubai, one in Singapore in the fall. So we run those trainings, get people up to speed, introduce our product, and but that is a bit of consulting. But I hope that within 2 years it'll be more or less out of the box.
How are you marketing the product, and how are you competing with other platforms that might be offering the same?
Yep. So how are we marketing it? Our approach is to work with value-added resellers in different parts of the world. Our first partnership is set up in February this year, and that's with a company called Ation. They were in the market since 1976, delivering solutions to banking in the banking sector, but also in the government sector. Value-added resellers, how do we differentiate? Today, I've come across one company doing exactly what they're doing. They're a company based out of India called Cryptsy. They're also working on middleware components for blockchain technologies.
And can you get into a little bit more depth on the team?
Yep. So myself, I was one of these guys on a bank, working for a bank. I've got about 12 years experience in banking. There I was the CEO of a credit card business. Later, I was the head of platform innovation for a retail online brokerage platform. That's where I started to become interested and learn about blockchain technologies. So my background is banking, expert team. Also, I've got about 6 years of my career was delivering month by month production releases for bank-grade secure software. My CTO, he's also got about 15 years now experience managing, he's straight from school, IT management.
The rest of your staff, what percentage is as developers versus other folks?
We've got 5 developers now, so it's about half right now.
Okay, guys, we'll leave it there. Matthew, thanks a million. Big round of applause for Matthew. Thank you. Cheers.
Thank you.
Okay, that's it for our second pitch finalist. Next on stage, the third and final pitch finalist is Alvaro Torralbo from Checkit, hometown company here in Madrid. Checkit specializes in software automation and UX to create tools for accountants that automatically speeds up processes, data recording, and bank synchronizations. So please give a big round of applause to Alvaro.
Hello, everyone. I'm Alvaro from Checkit, and I'm going to tell you about our project. Before I start, let me tell you something I'm sure you all feel related to, since all here in this audience are probably entrepreneurs or successful company managers. Company owners spend 1/3 of their time working on admin tasks. They have to. Some companies have their own accounting department in-house, or some others rely on accountancy firms, advisory firms to take care of this job. But in any case, they all have to deal with accountants. They have to deal with HR experts, with tax advisory, and it takes tax advisors, and it takes a lot of time from them. So this is where Checkit comes in. We want you to use your time the best you can do it, to focus on the things that are important, to focus on growth. So this is Checkit. Checkit is a platform that connects to any ERP and import information from the ERP, and also allows the manager or the person who is working with it to add information to the ERP. So we make ERPs online. If they are not online, we create this layer that allows managers to have a real-time view of how the things are going, if they have money on the accounts, if they don't have to wait till the accountant sends the information, they don't have to wait till the tax are coming. They know it in real time because we have connection to their ERP. So we connect to them and we open a new channel of communication. This is how Checkit looks like. We started focusing on accounting first, and we did the bank reconciliation. We connect the banks. So that was the first step, and people really liked it because they would have access to their bank information in real time, and then we connected to the ERP. And then we saw, but we continued with the invoices, the sale invoices. You could drag and drop the invoices, and also they were on the accounting system. And then we start also saying, why don't we also get information back from the ERP so the accountant, the managers have this information in real time. They don't have to wait for the accountants to tell them. So that's how we built all this platform. We come from a software engineering company. We develop apps, website, and we are really specialized in automation, web scraping, APIs. So that's how we started this project for us, for our own accountancy firm, to communicate with our own accountancy firm. And then we saw that this makes sense, this solves a problem, and we create Checkit. We are a team of 6 people now working with it. And when our focus, our markets is we focus on 2 big customer groups, accountancy firms. Those were our first customers because we saw that this tool would give them the possibility to share the information to their clients. And then we start seeing also companies, enterprises that have accounting in-house, but they also needed a tool like this because the owners didn't want to learn how the tool works. They just want a dashboard where they have all the information they need, and if they want a P&L, they require it and they have it. They want a balance, they have it. If they want to see the banks, of all the banks they have, the position of the whole company, if they have many companies, what they do. The business model is a subscription business model, so every company pays around €9 per month, 85 euros per month, depending on the services they are requiring, they are using. And this is our competition. These companies, do you see, they are not really our competition because they are online ERPs. we are not an ERP. We are a tool, a platform that connects to any ERP. Well, not any, but most of the ERP, the most important in the market. We have gotten alliance and a partnership with Sage, Microsoft Dynamics. We are starting also with SAP and Exact Online. And, well, we are happy to say that we reached this alliance with Sage at the beginning of the year. And thanks to that, they are offering our product to their clients because it adds value to them. And, well, this is it. We started a year ago, and they are on numbers. Thank you very much. I'm sorry I maybe took too much time.
No,
Sorry.
perfect. Brilliant. Brilliant. Oscar, we'll kick off the questions.
Sure. So obviously you're going to be handling a lot of sensitive information for companies. How do you ensure confidentiality and safe storage or avoid any issues with hacking?
Well, that's one of our many issues because we have information from the bank, we have information from the ERP, we have really, as you say, sensitive information. We try to have everything encrypted, all the codes and everything that can be done that way. It's everything encrypted, the connection to the bank and all those things. And then the information, we store it the safest way we can. I'm not the person in charge of security, but we have a person specialized in that part, and it's all saved in databases and as safe as it can be. It's really an effort we do because we understand that the importance of the information that we have and how sensitive it is and how dangerous it is if it gets outside. So yes, we are taking care of that. From the beginning, we approached that since we started with banks. It was the first issue we addressed.
Do you use APIs? Are you collecting credentials? How are you doing that?
With the banks, for example, we use APIs with the banks that have APIs. Not all of them in Spain. Not all of them have. They are starting. They will have to have one API in the future. So we are hoping they arrive fast because for us, otherwise we have web scrapping, which is the alternative, which is okay, but it's not maybe the most elegant way to do it. So we rather do the API approach. And yeah, we are waiting for the banks to open their APIs and allow us to get connected to them. We are starting with BBVA and Sabadell. They are the ones that are, I would say, more advanced at the moment, and we are very happy because with them, it's working. They are working very good.
Why don't the ERPs do this themselves?
Sorry, what?
Why don't the ERPs do this themselves?
Well, some ERPs are building also online ERPs. That would be the next generation of ERPs. But the traditional ERPs, such as Sage, Microsoft Dynamics, they are really huge, strong, and they need to be on a machine, on a server, and sometimes the companies don't want to have that thing online. They rather have it on their own machine, not on cloud. So what ERPs software vendors are telling us is that they are not developing online. They are also developing online solutions, but the big companies they feel really comfortable with the solutions they have already. So what we do, we make that online. We made online their actual ERP.
Are the customers mostly SMBs or?
Yeah, customers. Our customers are. Did you say?
Small businesses.
Small businesses. Yeah, SMBs. Yeah. They are small businesses, and also accountancy firms that offer our solution to these businesses, small businesses.
So then
we have some medium businesses as well. But.
Okay, the $9 to $85 euros a month. Why that?
That would be for a bigger company that want to have more services, that has maybe a group of companies with more than one company, and they want to add more banks or.
So someone that's being charged 9 versus 85.
9 would be like a really small company that just want to have, for example, access to the bank's account and connect that to the ERP, so they don't have to manually get the records from the bank and upload them to the ERP, for example. That would be a small company that uses a basic ERP, and they would be charged 9. And then a bigger company could be charged around 85. Yeah, that would be our pricing. I know maybe it sounds like it's too different, but we have many. We started with banks, then we added the invoices where you could drag and drop, and then we have this OCR to then go directly to accounting, and that's another service. Then we had this documentation area, and then this panel where we could get information from the ERP, and I don't know, it depends. That's how we are marketing.
Okay, Alvaro, we'll leave it there. Thanks a million to our last pitch finalist there, Alvaro. Thanks a million. Cheers. Big round of applause there. Okay, guys, three great pitches there. I imagine it's going to be quite a difficult decision for the judges to pick the winner. Just before we break for deliberations, what are your kind of early impressions, maybe opportunities, concerns? Jay?
Well, overall, I think good job, guys. I know it's really, really hard to put this into 4 minutes, and sometimes it seems like it's in a second language, I think, in some cases. So overall, great job.
Yep, Catherine?
I think I would have loved to have heard more about how folks are going to market to their various constituents, whether it's small businesses or whether it's through, settlements that they're going through resellers. It just seems, I'd love to hear more about the strategies behind that. So it sounds hard.
So for startups who may be pitching next year, the go-to-market strategy, key. Oscar?
Same. I'm on Catherine's boat. I would have also liked to hear a bit more about how what the go-to-market strategy is for some of them, especially given the challenging economics. Some of these
and even the team. Like, I'd love to learn more about the teams in each one.
Yeah.
Just because they're all so early stage, just to get a little bit more understanding of why they are the right guys to do it. Or.
Okay. So big thanks to all three of our judges here. You guys are going to go back there and deliberate for a while. We'll be announcing the winner of the competition at 3:50 in 30 minutes. So do come back then to find out who the winner is. But other than that, I thank you all for your time, and big thanks for watching the final.
Great. Thank you, Patty.
Hi everyone. So we're going to hear the results of that pitch final. The judges are off deliberating right now. They'll be coming back and we'll be announcing those results shortly before the end of the day. In the meantime, we have one of the best commentators, in my view, on the fintech scene. It's the Chief Innovation Officer for DBS, Neil Cross. He's going to be up here in 2 seconds to talk to you about artificial intelligence and banking. But, we all talk about artificial intelligence. It's one of the big buzzwords around right now. But what does it mean for the banking sector? What does it mean for the financial sector? So please join me in welcoming him on stage, Neil Cross. Neil.
How are we? Good? Come on! Jeez, I'm doing an 18-hour trip for one day in Madrid to come and talk to you. So thank you for the welcome. I've got to fly back to Singapore after this. I'll keep it really short. I don't know why I've been asked to speak on AI, because I can't even spell it. But let me have a chat about what I'm seeing in the industry. There is a presentation somewhere. Down, there we go, thank you. So I'm Neil Cross, I'm the Chief Innovation Officer at DBS Bank. I'm also a social entrepreneur, co-founder, investor. AI in banking, have we got it wrong? I think to some degree, certainly. to a large degree, no one's really talking about the really important thing that AI is going to impact banking for. And I think some stuff we've kind of got right. But if you look at the recent history with AI, so in 97, Gary Kasparov was beaten by the IBM machine Deep Blue. And everyone assumed at that time that artificial intelligence was just around the corner. Playing chess was one of the hardest things that a human can do. Only the smartest humans could play chess. The fact a machine could beat someone at chess meant that machines must be better than humans. Of course, we laugh now, don't we? We look back, playing chess is about pattern recognition, predictive analytics, but more importantly, machines never make a mistake. That's definitely a human role. And we've done that again with Go and Google. Did anyone see what Jack Ma said recently about AI? He said getting AI to beat a human at Go was a stupid idea. Go is a game which humans use to entertain each other with. It's something we enjoy. Why would we ruin it by getting machines to beat us at it? Why don't we focus AI on things that humans can't do? Why are we fascinated with replacing humans in all different contexts? Why aren't we focusing on doing things that humans could never do? So anyway, 97, IBM, Gary Kasparov. Because that didn't happen, because AI wasn't as advanced as we thought it was, it went into a winter. So we had an AI winter for a number of years, from 97 to 2000s onwards. And then we started to see it come back. So some of the early banks using it were Citibank with their chat robot, NAB in Australia, there's a good example as well, selling credit cards. And then IBM did it again. IBM, with Jeopardy, beat humans at a game. And everyone's thinking AI's around the corner, driverless cars, machine intelligence, loss of jobs, universal basic income, often known as social security in most places I know. So are we again overrating the capability of AI and AI in finance? The first thing I want to talk about is robo-advisory, which in fairness is neither robo or does it advise. So many of the early ones are pretty much, you get a free pie chart with every ETF sold. But these are changing now. So they're moving away from very basic algorithms to balance portfolios into chat-based kind of wealth platforms and moving away from aggressively monetizing client, trying to sell them something, and moving into the advice piece, so actually trying to help people get financial happiness. Because for me, that is the vision of robo. Most of us on this planet are unhappy with our finances. So maybe that's a better problem to solve than just trying to monetize them through ETF sales. Will robo-advisory replace all advisors? No. Not at all. Even in China, where about 20 to 25% of all wealth is done through fintech, when you move into more affluent wealth, it's done with people. People buy from people. So 52% of all transactions, all payments in China are done using fintech. In case you didn't know, by the way, China is the fintech capital of the world. Everyone else is, 10% or 1% of what's happening there. 52% volume of all payments in China are done using fintech. By value, it's 5%. Which means if you're doing something important that's high value, you'll go to a traditional organization. So I think the same with robo. It will continue to add value at the bottom layer as long as they start to grow up in terms of putting real intelligence in there and really helping clients understand their finances across the board, not just their investment. But I think it will hit a ceiling. So I think we're right about robo. I think the next generation and what we're starting to see now are much better examples of that. It won't replace all advisors. This robotic process automation, what a ridiculous term, RPA. Essentially, what it means is it's going to automate a lot of the stuff which happens in a bank, and it can do lots of repetitive tasks and always gets them right. But think about an operations department in a company. So an operations department in a bank, they are mainly there because the computer said no. Yeah? So the customer couldn't type into the mainframe. And so the customer filled out a form to open a bank account or get a product. It went to a person in operations. They typed it in, and it went into the mainframe. So the computer couldn't do something. And so humans were put in to manage that process. The second thing is this machine couldn't talk to this machine. And so this machine would spit out a process to a human who would do something and then type it in this machine. So the vision of RPA, it will fix all of that. So I think it will have a huge impact, not just on finance, but across every industry, where it'll be able to automate a lot of those tasks. What I love about it is then we can refocus those teams and that money into doing more innovation. So RPA, absolutely, is going to have a huge impact on the finance industry. Chatbots. So as I said, Citibank were very early in chatbots, NAB were early in chatbots, but in fairness, they're still just slightly smarter FAQs. You can't really have a conversation with them. What they do is fix the mobile phone problem, which I feel is really exciting. So if I want to find out how much I spent on coffee this month or any random thought I've had about my finance, in internet banking, I can download it in Excel, I can filter, I can find that value. On mobile banking, but chatbot, you can type, we did this in India and Singapore, how much I spend on coffee in a month. And so it solves the interface problem that's inherent in a mobile phone. We use Kasisto in India. We created the world's most innovative bank called Digibank. To open the bank account, you download an app, you go into one of 500 coffee shops, you do a thumbprint, and then nothing. You're done. Full bank account on your mobile phone. You didn't even type in your name. 85% of all customer requests are serviced by chat robot. 85%. And so chat robots are being very successful, but it isn't about the technology. The difference between a great chatbot and a dumb chatbot isn't actually technology. And this is the danger, that customers will get fed up of talking to dumb chatbots and write the technology off as something they don't want to use. I'll tell you for why. Look at how a chat robot works here. You've got the tech, that's interesting. But then you've got the basic conversational layer. So when you chat to it, who are you? What's the time? What's the weather? It can actually say something back that isn't like, duh. The next level is the industry information. And so when I say cards, I don't mean birthday cards, it's credit cards. Yeah? And so it understands the terms in finance. The third level is the language. So English, Bahasa Indonesia. And so you have to localize the English. But where most chatbots fail is the next level. It's the localization, the colloquials, the slang of that culture. And so we spent a year refining our chatbot in India, so it was good enough to service 85% of clients. We quickly took it to Singapore to do an experiment, and it was like 2 different chatbots, because we didn't spend the year localizing that. And so the danger with chatbots, as I said, customers might get fed up with them, that they're too dumb and keep going back and go, duh, I don't know. Or they come back with some funny response. With that, I'm on the fence. We invested in Kasisto, so I'm kind of a bit over the fence. I think it's going to be successful. I hope it's successful. But I believe the jury's still out until we see more mass adoption, and the consumer will tell us. Another thing I want to talk about, I see a lot of, we all see it, about universal basic income. There's going to be lots of job losses through to automation, robots, AI, and lots of crazy ideas about how the world's going to be around this. What I do see is a lot of software people and data scientists saying, it's okay, I won't be disrupted. Absolutely, they will. Absolutely. Do you know there's less data scientists, less people focused on data now than there ever was in human history? Per megabyte stored. Years ago, one data scientist would have 10 ropes with 10 knots in to store values, or pebbles or an abacus. So per megabyte stored, actually the amount of people in data is going like that. Of course, data is going like that. So we all think there's more people, there's actually less. But think about how software is going to be built in the future with the help of AI. So this is how we are going to build a mobile banking app. You ready? I'm a customer, and I go, I want the DBS Digibank app. I do a lot of foreign exchange. Please put that in there. I want a points platform focused on air miles. Also, I want a personal financial management tool, and I want to look at, kind of equity funding. Go. Bang, it's built. That is the trajectory we were on, yeah? When I was a kid coding games at 11, I was typing ones and zeros into the CPU, basically. I was writing assembler. I did a website for my social enterprise. I used Wix, I dragged and dropped, and it was done. And so that wave is continuing. Basically, the ultimate is the customer describes the experience they want, and it gets self-built. And we're not too far away from that. So software developers, data scientists, if the world does go to a point where mass automation happens, certainly one of the industries which will be disrupted. And so through all of this, we've got some stuff I think isn't going to work. We've got a lot of stuff on the fence. We've got some stuff we think is going to work. But why are we fundamentally wrong about AI in banking? Because we're looking the wrong way. The biggest disruption to the finance industry and to all corporations about AI is nothing to do with technology in banks or in fintechs. It's the fact the world's going to fundamentally change. So what happens when a company has less staff because they've automated? When they're driven by data and machine intelligence? When we move to the gig economy, when companies are constructed out of ecosystems, that will fundamentally change corporate banking. AI will be changing the companies we bank. That's the biggest effect on finance. On the consumer side, gig economy. Everyone's going to be an entrepreneur. They're going to have very different careers, many different jobs, make money in very different ways, have short-term positions maybe. It's going to fundamentally change consumer banking. And so actually, we're wrong because that's what we should be looking at. Our customers are going to be changed through AI, and that's going to have to change how we operate as a bank. So thank you. I've got to fly to Singapore now. I hope you enjoyed it.
Okay, there we go. Hi, everyone. Thanks very much, Neil. Hope you enjoyed that. So next up, we have, with one of the CEOs of one of the world's leading challenger banks, Atom Bank, Mark Mullen, will be on stage shortly. He's going to be in conversation with Laura Noonan, and it's banking. What's wrong with it? How do we fix it? One of his specialist subjects. So please welcome on stage Mark Mullen in conversation with the Financial Times' Laura Noonan. Please welcome them on stage.
Thank you all for joining us this afternoon and making it back after lunch. Today we're going to talk about the traditional banking model and why it may be broken. So, Mark, you spent most of your career working at a big and broken bank. Why do you think it's broken? And what are you doing differently in your new bank, Atom?
I think it's a short question, but there's probably a very long answer. I haven't got time to give it. I think the way that, speaking specifically about retail banking, the way that banks generate revenues, the way that they cross-subsidize between products on the revenue side as opposed to the loss side, the way that they conduct themselves and how they have rewarded themselves are fundamentally at odds with a fair, transparent, or in any way effective for all banking model.
So you're talking about the way the banks make a lot of money from certain products, like say overdrafts, and then they don't charge you for others, and that leads to an unfair system, or
well, listen, absolutely. So in the UK, certainly, but elsewhere also, banks are quite prepared to offer incentives to encourage customers to join their franchise. And I have a problem with that because it's lost leadership. In the UK, the law says you can't sell alcohol at a loss lead because it's bad for your health. But apparently you can sell a banking product as a loss lead because that's not bad for your health. But if we've learned anything in the last 10 years, we've learned that there's a whole bunch of banking products that people have bought that have turned out to be extraordinarily bad for their health. And that's only one example.
So you then went and you were working with HSBC, was it, for a number of years?
Yeah.
And then you decided to leave and set up something better. Tell us about Atom and why it's better than what's gone before.
So we, myself and Anthony Thompson, our sort of co-founder, decided to create a bank because we shared a similar viewpoint in respect of how banks work today. Fundamentally, they're quite inefficient. So operationally, they're expensive, they're complex. They don't manage obsolescence effectively. They don't invest fundamentally enough in their technology or their capabilities. And that makes them inefficient. But their inefficiency is masked by their advantages in capital and their advantages in liquidity. And they have all the customers, and essentially, they have all the money. So we set upon a challenge to build a bank to compete with them. Not to compete with small banks, not to compete with new banks, but to actually go and compete with the very biggest banks in our market on the basis that we can just be more efficient. And that requires that we do fewer things, we serve fewer customers, we don't have multiple channels, we're more focused, but we're still driving a scale model.
So you've got a single online product, or you have a single online channel, and then the product suite so far is savings plus mortgages?
Yes, savings. We lend money to small businesses. That's not digitized properly yet, and we have a mortgage proposition.
Okay. And when you think about how you're doing business, what's to stop somebody else setting up the same way you did?
Absolutely nothing.
What is unique about yours?
Absolutely nothing. There's nothing to stop any entrepreneur out there from going out and replicating what we've done and possibly making fewer mistakes than we've made in the process. So it's the nature of competition. I suppose the challenge is do something different. Yeah, so replicating something that's already out there seems a little bit wasteful, but direct answer to your question is nothing whatsoever.
And is there anything to stop any bank from deciding, right, we're going to set up a low-cost, efficient brand within our bank so that you don't come along and take their customers?
Listen, there's lots of case studies around the world in the banking industry and well beyond the banking industry where big businesses and big brands have set up fighter brands. And they've done it to try and protect themselves from attack, or they've done it to protect their margin in one way or the other. And I arguably used to work for one of them. I led First Direct in the UK, and it's has that potential role in the context of HSBC's operations. Again, they can do it, but here's the thing. It's still part of the same group. And my experience with big banks is they are almost conditioned to look for synergies. And when they start to look for synergies, they pull autonomy and they aggregate investment. And in doing so, they actually bring the banks or the businesses that they buy or that they create closer together because they think that's a more efficient model. But that begins to contaminate and get in the way of the independence and the spirit and the fight and the purpose of those brands. So in principle, nothing whatsoever stops the banks from going and doing that. In practice, culturally, it's been my experience that they struggle to allow independent entities to exist in groups.
Because the evolution, I think, is really interesting. And when you think about Atom's evolution, presumably, ultimately, you want it to be big. So how do you protect the kind of low-cost, simple DNA as you yourself become a big bank, if you become a big bank?
So one of the things that is really important about our business model is that is a little quote which I like, which is the art of the minimum requires the maximum discipline. It's really painful to do very few things because when you build a business, you're infused with joy and excitement. And a whole bunch of people come and join you because they want to create stuff and they want to be imaginative and they want to do all the things that they couldn't get to do where they were. And then they meet you and they think, oh, but you actually only want to build a box that's that size. And then you've got to manage them through that journey. So it takes the form of very few products, very simple products, mono-channel distribution, but it also takes the form of policy, which I think is sometimes missed. That in our industry, the customer experience is as much driven by your policy as it is by your product or your service or your proposition. So
and what
how
do you
can
mean
you be
by your
simple?
policy?
I mean, what are the upper and lower limits? What do you allow and what don't you allow? Because it's very easy, very, very easy to allow your proposition to tailor itself to a whole bunch of different customer groups. But it's also expensive. It's also expensive to sort of say, well, you're a customer that wants something slightly different. Technologically, we can do that, and the temptation is to go do it.
Yeah.
But pragmatically, the minute we start down that road, we will lose whatever efficiency advantage we're striving so very, very hard to create.
So do you end up spending a lot of your time saying, no, we can't do that, we're going to just stick to this suite?
Yeah, I think we've learned. Initially, we thought that we would go and build a small proposition, and then we would broaden that proposition, and then we would grow it. Now we're build a small proposition, grow that small proposition, and then broaden it. It's a very different route. So in the end, we still want to achieve the same thing, but we're now conditioned to saying that we've got to start smaller in our scope and our scale and focus on growth. Stabilize the business, generate a sustainable revenue stream, and then invest in the next stage to broaden the product set and broaden the proposition.
But do you ultimately end up with a product set as broad as what the big banks have now?
No, I don't think we do necessarily, because there's an awful lot of products that big banks have now that they wish they never had. That if they could wind back the clock, my goodness, they'd get rid of a lot of the
travel insurance, or what are you thinking about?
Package banking, for example, is one of those complex products that people are concerned about. Did they sell that product properly? Can they administer that product economically? And here's the thing, do they even know whether they make any money out of the damn things? So no, I don't think it follows that we end up with the same product set at all. But I will say this, the banking model is an evolved model, and it's a self-hedged model. And if you run a bank, then obviously having young customers and old customers, big customers, small customers, short tenors, long tenors, high risk, low risk is a good thing.
It's an offset.
It's an offset, right? It's a self-hedged model. It's a pyramid, as it were, that makes the whole thing stand up. So anyone who thinks they're going to build a bank for young customers only is going to have a problem if they have a banking license, because it's very difficult to stabilize a bank with only one type of customer. A good, stable bank actually needs a blend. So to some extent, yeah, we will evolve and grow, but hopefully, intentionally, we'll avoid the complexity that the big banks have today.
And just for a bank starting out, in order to get your customers, I mean, do you really need to offer something at the kind of higher end of the risk spectrum, or offer something at the more aggressive end of the pricing, or how do you go to market without any brand and say, right, you should come to us for your mortgage or for your SME loan rather than coming to the bank that you've known all your lives?
So we don't fight shy of a conversation about price. If you go and build a mono-channel bank, so for all the talk about apps and for all the talk about digitization, lots of the propositions are mono-channel. And I'm sorry, but grammatically, if you're dealing with a bank that has 5 channels and you're offering only 1, then that's less when I last counted. And for less, I expect to pay less. So don't fight shy of the obvious answer. If you create a self-service business model digitally, translate the benefits of that, not just into the experience that the customer has, but into the price point. Because we're dealing in money here. It's commoditized money. I said it yesterday, I'll say it again. And our job is to make sure that we add as little cost to that money as we possibly can. So recruiting customers on the basis of price is not something to be ashamed of for me. It's an intentional strategy. It's what we want to be.
And do you expect to always do that, or is that about the kind of start of customer acquisition? Like, do you see that almost as part of the marketing spend?
I think that's fundamentally part of our DNA. I absolutely expect us always to do it. I don't understand why we would go to the trouble of building a self-service, low-cost business model if part of the deal with the customer wasn't an expectation that we were going to be aggressive and competitive on price.
And can you tell us a bit about the customer profile so far? Is it the kind of millennial types who you'd expect to be open to this kind of online only and who would be maybe more aggressive in switching, or has the customer profile kind of diverged from that?
No, not at all. So the average age of a saver with Atom is 56. And it should remind you that 56-year-olds use iPhones too and use Android devices. And here's the thing about them. They're looking for good value. They have money to save. Their deposits are protected. And we're a bank that can provide that service to them. So we're very, very proud and very happy that our savers are those customers.
And the mortgage product?
Mortgage product is going to be pretty similar to any mortgage product in any other bank in the UK. The people who are buying mortgages in the UK are in their 30s or in their 40s, depending upon whether it's a purchase or a remortgage.
And you've got some very competitive pricing there, don't you? Do you want to talk us through the mortgage pricing strategy?
So we ran a mortgage offer about 6 weeks ago, where we took a market-leading position on a 5-year fixed-rate mortgage. I think we priced it at 129 or 139. I can't remember.
Which is an incredibly low rate for a 5-year.
Incredibly low rate, absolutely. But here, we're new. We launched our mortgage proposition in December of last year. We want to grow it. We want to prove it. We want to test our model. But we also want to assert ourselves in the market. Fundamentally, however, if you're going to, again, focus on the cost and the efficiency of the business, translate it into a benefit that the customer can feel. And the benefit that a customer can feel when it comes to the most expensive purchase they ever make in their life, frankly, is in their monthly repayments.
I guess I'm just wondering, can you sustain a price point that low? And how hard did you have to argue with, say, the Bank of England to say, we can cover the cost of risk if we lend 5-year money at 1.29%?
It's a very fair question, but we're not given any free ride by the regulator in England when it comes to the expectation of our enterprise risk management framework, right? So we are of interest, as you can imagine, to the PRA and the FCA in respect of the velocity of the business.
Yeah.
We have a hugely experienced chair of our board risk committee, and we have 2 hugely experienced people in our chief risk officer and our chief credit officer. And I'm talking decades of experience between those 3 people. So we're not doing anything lurid. We're not taking risks. In fact, if we're going to be criticized, it's because we're not going up the risk curve. We're not going up the high LTV range. We're not chasing margin. We're actually chasing really high quality, really low risk assets. And there is a logic to that for us because we're in the business of building a bank for the long term. And fundamentally, one of the criticisms of the new banks that are out there is that they haven't been through the cycle.
Yeah.
Well, we haven't been through the cycle either, guys, but we have no intention of exposing ourselves, our customers, or our shareholders to that cycle.
So what's your kind of aspiration? I mean, is your aspiration in terms of your annual growth rate, or how do you kind of look at the KPIs going forward?
So I think it's evolved from where we started. When you start a business, you're looking for world domination. It's sort of, it's the stuff of imagination more than it is the stuff of hard reality. As we've grown in our experience and through failure, frankly, there's no other way to do it. Now it's pretty clear to us that we genuinely have an opportunity to transform the efficiency of the core banking model itself.
And only in the UK, or do you see opportunity beyond that?
I get asked this question a lot, but hey, the UK is a big market, and there's a heck of a lot of stuff coming down the pipe in terms of regulation. There's Brexit, obviously, 2019 drop date. Our plan is to focus on the UK, build a really substantial and strong business and a good reputation, and then look again as we get towards the back end of that journey and think about where else we might be able to take it. But we've got such a lot of work to do where we are that I'm not really looking.
So we're like 5 years out from the conversation about other markets?
That we could be, but I wouldn't be so absolute in judging it because we also are building an architecture that is designed to be flexible and agile, and we want to be able to respond. And we're already talking to a couple of partners in Europe about our core banking proposition, and they're real conversations that we'll execute this year. So you don't have to be in the market in order to be able to offer value to the market or take value from it.
So you could sell into some other European markets from the UK passporting, I guess?
No, you don't even have to have a licensed bank in those markets. There's all sorts of different relationships that you can have on an interbank basis that benefit both parties in a transaction. And I'm not going to elaborate on exactly what those conversations are.
Tell us more.
No.
It sounds very interesting. Beyond that, I mean, what's the end game? Because obviously you have a large bank as a shareholder now, BBVA, which I'm sure people know very well. Is the end game to try to sell it as a whole thing to a bank? Is the end game to try to IPO it, or where do you see it going?
So we can't prejudge what our investors want to do with the business. It is their business, right? They own it. BBVA is one of the primary owners and a strategic partner in the journey. We get to run the business in the best way that we can in the interests of the shareholders, in the interests of the customers. I can't predict or make decisions with a bias in favor of one outcome or another, especially when you've got quite a diverse investor arrangement as we do. We've got some pretty big investors in the business. So all things being equal, we have a plan that gets us to break even and sustainability and ultimately to a liquidity event. But whether that liquidity event is a trade sale or whether it's an IPO, frankly, is not something that I lose sleep over.
But it sounds as if you don't think it works terribly well to have a new young fighter bank within a larger banking group.
No, I said I've not seen evidence in my experience. And I've had very direct experience of working in subsidiary brands and companies in a very big group, right? So it's not hearsay. My experience suggests that big banks struggle to let subsidiaries alone, to take a more hands-off, go build, go be separate, go be different, go be a different culture potentially. They struggle with that. Is that going to be the case if we think about an open banking world? Probably not. In an open banking world, if you think that you're going to follow or try to replicate what might be the anti-conglomerate discount model, in other words, just chase those synergies everywhere you damn well can, I think you might be mistaken. I actually think that there's an opportunity for many more brands in banking, not many fewer.
And what are the advantages to the current shareholder structure? I mean, in terms of the relationship with BBVA in particular, is it just a financial one, or do you guys help each other, or what's the interaction like?
We've got a great relationship with BBVA. In fairness, we've got a very open relationship with all of our shareholders. So it does extend beyond, let's just talk about money. Let's also be candid in this room. The money matters. And it matters very much if you're growing, if you're allocating it to risk-weighted assets and you're growing a balance sheet. So we shouldn't be glib or naive about that. But it does extend into conversations about architecture, conversations about technology, conversations about strategy, conversations about pretty much every aspect of the banking.
And have you guys learned things from them, even though they are a big bank and arguably part of the broken system? How they taught you things?
Of course we have. Listen, one of the mistakes you make is to think that the people who run, build, and grow big banks are in some way less intelligent than the people who are in the sort of fintech sector. That's just not the case. They have a different problem that they're wrestling with. That's the difference. It's not that they're less intelligent or less wise people. Far from it. They're bloody brilliant people all over the banking industry, that has been my experience. But they didn't get a blank sheet of paper at the beginning.
Yeah.
They inherited stuff, and they're trying to shepherd it and make it better, right? And that's just an order of magnitude problem different. So of course we've learned from them, because they've had more experience doing the things that we're doing in more markets over a longer period of time.
And are they also kind of encouraging you to get into some of their international markets? They're obviously getting along.
No, actually, that's not a conversation that we're burdened with at the moment, which is, why don't we just get on and build Atom and focus our attention on that? I think they're quite pleased for us to do that.
So how much bigger do you expect Atom to be in like 5 years' time? So now you're at a balance sheet of about, what's your current balance sheet size, and where do you think?
We'll get to about 500 to 600 million by the end of this month.
Okay. And what do you want to be in 5 years' time?
It's an incredibly difficult question to answer. Multi-billion pound as a minimum. It's very clear to us that if we execute the plan and the strategy that we now have, that's entirely possible.
And where do you see break even?
we see break even still about 3 years, 2.5 to 3 years from now on a run rate basis. But then that's a choice.
Yeah.
We can extend that if we want to get bigger. And it very much, again, depends on what constitutes value from an investor perspective. You know, what are the KPIs that they're most interested in? Is it break even? Is it growth rate? Is it cost efficiency ratio? It's been my experience running businesses that you can have maybe 2 out of 3 of them, but it's bloody difficult to have them all.
Cool. I think we have time for a single question from the audience, if we have anyone, and then we'll have to wrap it up. So, any questions from the audience for Mark? Okay, you appear to have already answered all of everyone's questions, so I think we're going to wrap it up there. Thank you very much for your time, Mark, and thanks, guys, for listening.
Thank you. Thanks, Laura.
Ladies and gentlemen, to announce the winner of MoneyConf Pitch 2017, please welcome back to the stage co-founder and CEO of MoneyConf and Web Summit, Paddy Cosgrave, along with our head judge, Jay Reineman.
Fantastic. So the moment of truth. Jay, before I turn to you in a second, we had a fantastic pitch competition. We had over 2,000 applicants from all over the world. Over the last day, yesterday, we some fantastic startups pitching, and a huge number of VCs and entrepreneurs took part in the judging. And I'd just like to ask you to put your hands together for all of them and for all of the startups that participated. So, Jay, what were your thoughts before you announced the winner?
It's been a great show. I mean, we're almost at the end. It's a little bit sad. Sad it's going to be leaving Madrid, but we'll have fun in Dublin also. Really impressed with all 3 of the finalists. It was really a hard decision for us. We understand that it's really tough to be up in front of a big stage, especially as a company that oftentimes these guys are so early that it's sometimes confusing in your own language. And so anyways, great job for all 3 of them. It was hard to pick, but we did pick one.
Right. Who is it? Tell us.
So the winner is Sezam.
Congratulations. Come on up on stage.
Sezam. Good job.
Congratulations. Well done. Here you go. Let's all get you go in the center. We'll do some awkward presentation.
Thank you very much.
It's great. You hold it as your trophy after all.
It's a really custom trophy. Very cool. Really amazing.
So, will you give us just give me a very quick kind of 20 seconds, 2-3 sentences on the product.
Okay, on the product, we're actually aiming at providing predictive indicators based on textual public data. So we're extracting millions of messages from the web in real time to provide it to banks, hedge funds, several kind of asset managers, which can then integrate it into their investment process and strategy. So that's it.
Fantastic. Congratulations. Thanks a million. And thanks, Jay, as well. Thanks, guys. Looking at the bigger picture, how has Europe's financial environment been affected by recent economic and political changes? And how will technology help create a supportive ecosystem to accommodate for this, as well as implement the change needed as a result? That's an amazingly long sentence I'm reading. Please join me in giving a big welcome to the economist Tom Nuttall in conversation with the founder and CEO of Creditech Alexander Graudner-Muller, and Global Head of Digital for HSBC, Josh Bottomley. Good afternoon, everyone. Welcome to the last panel of the day. Hopefully we'll have a lively discussion for you. European finance, 1 year on. I'm Tom Nuttall. I write the Charlemagne column for The Economist, and I'm joined by Alex Graudner-Muller, over here, to my right, CEO of Credit Tech, which is a consumer lending firm that uses data mining and AI to provide credit to the underbanked in 5 markets, soon to be 6. And to his right is Josh Bottomley, who is Head of Digital for HSBC, formerly of Google. So we haven't got long. I'll get right to it. Alex, we were just talking backstage, and you were suggesting that perhaps you're a little bit more optimistic about the future than you might have been a year ago. Why is that?
Well, I mean, if you would have asked me like 12 months ago, right? I mean, were we going to be sort of like in 12 to 24 months of time? I think it would have been a real difficult question to answer because a year ago, I mean, there was a large amount of uncertainty. I mean, how do things like Brexit will shape out? What's happening with the US elections? How do sort of like all these various, I would say, regulatory initiatives will shape out that were already pending, like PSD2, GDPR, IFRS 9, and so on. So I think it would have been a real difficult question to answer. Now, fast forwarding a year where we are today, I actually think that the next 12 to 24 months are going to be super predictable. I think there's clarity around, I think, the major, I would say, political things. I think, the rise of populism to some extent has been halted. I mean, we saw that in the Dutch election. We saw that in the French election. I think the German election looks pretty stable. I think there's to some extent clarity around Brexit. I think the regulatory initiatives, I think PSD2 to some extent is now pretty tangible and to some extent, I would say even disillusional for fintechs. There's clarity around the economic situation, so I'm actually pretty positive, and I think the next 12 to 24 months, I think will I think be a very, I think there's a very clear path, and I'm very happy to share a few more details on.
Yeah, I mean, as a fintech firm operating in Europe, you're having to deal with a regulatory environment which is constantly evolving. Regulators in places like Brussels, the town that I live in, that may not always understand the world in which you're operating in. So give us a sense of, give us your sense of how well you think the regulatory environment is coping with this rapidly changing sector that you operate in.
So, I mean, I would say there's a couple of important things that are in the making right now, and I guess probably the 2 most important ones I think that are going to affect I think fintech in particular are going to be PSD2 and GDPR. I think PSD2 is a very interesting one because I think the entire industry actually had pretty big hopes in terms of, hey, I mean, it's liberalizing the consumer with regards to access to bank account information, and there's sort of like universal standardized APIs that financial institutions have to introduce, and there's sort of like it basically will catalyst an entire ecosystem of like additional services that will sit on top of that data. Now, the way how the regulation is actually taking shape right now, I don't think it will actually deliver to its promises, which I think probably not many people have started to realize. But the way how, I mean, at least sort of like in the latest version, I think the technical standards have been drafted and so on. I mean, they leave a lot of room for interpretation. And I don't think at all that PSD2 will create the clarity and will provide, I think, what actually people have been really looking up for it to provide.
And talk a little bit about the sort of the broader financial space that you operate in. I mean, you have a representative from a very large bank sitting next to you. Yeah. He's very friendly, but are the larger banks in Europe are they receptive to the sort of ideas and the sort of operations that you bring into this world?
Well, I think there's. I mean, when we started 5 years ago, right, and fintech wasn't a term yet. It was very, very difficult, I think, for a startup, I think, to set foot in the financial services space. And everything which was related to bank partnerships and so on was just extremely hard. It was, you were basically pitching against closed doors. Now, fast forwarding 5 years, it almost feels like if you're a fintech, you have an interesting product and so on, you almost get proactively approached by banks in terms of speaking about potential partnership opportunities. So we think that this is actually, a big win, I think, for the industry, that there's a lot of openness when it comes to cooperations, partnerships. In some way, it's also still a bit of like education and learning and so on. But at least, there's a dialogue, and I think there have been a couple of very successful partnership models between banks and fintechs. And I think over the next 2 or 3 years, I think actually the fintech companies are going to be the most successful, and not those that drive a clear B2C approach, but those who can actually play both B2C and B2B2C.
Yeah, okay. Josh, can you give us some perspective on that from the other end of the telescope?
Yeah, I think the world is very different now in terms of the partnerships that we can do. So as you said, I joined from Google, and one of the very clear objectives at the beginning was we don't need to invent this all. Just on the retail side, HSBC is in 39 markets. In many of those countries, we can be a challenger bank. We're subscale. I thought we'll go and find some partnerships and make it work. And in reality, up till now, it's been very difficult to partner because of well-known issues. You've had fintechs who were very naive about some of the KYC and the regulatory constraints. We've had back-end systems, and we haven't got the APIs to make it work. So what's, I think, really interesting now is that some of those opportunities really exist. So with Alex, there are certain markets where we can't get enough data to assess credit for our customers or for prospects who come in, and actually therefore partnering with someone like Alex to say, well, let's go and attack or address this part of the market that we otherwise couldn't do now exists. Or if you take another example, robo-advice, that even a year ago we were all saying, is this a fintech opportunity? Well, no one's even raised it as far as I can hear the last 2 days, because everyone knows having a robo front end is just what a bank can do, and you could be a startup service provider, but it gets there. And there are 2 new ones still coming through. I think the area of KYC and having customer permissions, and Alex, you mentioned the PSD2, that's not been solved yet, and banks won't solve that by themselves. So there's a huge area of the KYC, I think, associated with PSD2. And then the other one is, I'm sure we may come back to it, but the whole distributed ledger, the blockchain, as an enabling technology. So not as a customer proposition by itself, but to say which of the use cases and how do we scale that up. So I think there are some ones that are more mature, and there's some very big ones that are now coming through.
You speak of blockchain as an enabling technology, but when you survey the landscape, what are sort of the interesting, sort of fundamental new ideas that you see bubbling up in this sector, if any?
Well, I think it's a really good question. I came from the media industry in the late 90s, and at the time, every week or two, a model would come up, and you'd go home, you'd be really excited. You want to show people, because have you seen this thing? It's a search engine. It was Alta Vista even before Google, and it was doing things you couldn't do that with Yellow Pages and offline. You couldn't do it with the encyclopedia, or with user-generated content. And how do you the starts of TripAdvisor? These things were really fundamentally different. They weren't doing the same thing a bit better and faster. And actually, one of my challenges out there is, whether it's for us, for ourselves, or with ecosystem, there aren't yet enough propositions, certainly at the consumer end, which are dramatically different from what's been there before. It's doing it better, faster, simpler. I think that's slightly different. I think some of the capital market stuff is more radical, but I don't think we've yet seen some really radical consumer propositions.
Okay. We're meant to be here talking about looking ahead a year into the future. One thing that we'll be thinking about a lot then is how the negotiations over Brexit are proceeding. Those talks are likely to begin in the next 10 days, 2 weeks or so. And when it comes to financial services, of course, a lot of concern in London over the future of the city. How do you think these talks are likely to shape out? And for both of you, from your very different sort of perspectives, what's at stake in these talks? What's most important? Let me go to you first, Josh, because you're based in London.
So I think, from HSBC's point of view, we are a global bank. More of our profits are made in Asia than anywhere else. And we've said, we're based in London. We had a review about moving to Asia, and Brexit isn't going to change that headquarters decision. As HSBC, people talk about two things. They talk about the passporting and the implications for that. We have big subsidiaries in France. We've got corporate banking in Germany, elsewhere. I think for us, and actually I think for most fintechs, there will be ways to manage that through partnering. I think the skills issue is a much bigger one. The ability, and we very clearly as HSBC, we want clarity both for our staff working abroad, but also people we want to bring in to do that. And the point I would make is for us, and different people in different contexts, our choice isn't London versus Paris or Berlin or Hamburg or Milan. I mean, I have real decisions that I have to make every month about whether to put teams in London, in Hong Kong, in China, in the US. And these are teams that I want to manage global code bases. So I'm very keen that we have a model that, UK, in Europe, EU, that keeps the incentive to keep people there rather than move it to Asia or potentially North America. And
how likely are we to end up with a model like that? I mean, what are you hearing from government when you take these concerns to them?
We get a good hearing. I think there are enough people making it very clear, certainly in the UK, that clarity for skilled workers and making that possible and clear is a message that gets put, and it's well heard. Clearly, with an election tomorrow and changes, I mean, the proof of the pudding starts, I guess, next week.
Yeah, indeed. Okay, so Alex, I mean, you're not based in London, so presumably Brexit will not have a sort of an immediate impact on your work. But tell me a little bit about the importance of the skills piece of this for you. Does your recruitment largely take place within the European single market? Do you recruit outside of Europe? How easy is it for you to do so?
So, I guess finding excellent talent is probably one, or probably the most important challenge. I mean, that you deal with once your company is sort of like at the growth stage. And I guess probably the two of us have the same challenge, but from a very different point of view. Because I mean, we started as a tech company, and actually even like our original idea was not even to build a lending business, but to build a technology business. We just sort of like slipped into lending by accident. And the DNA of Credit Tech is really that of a tech company and of a data science company. And only when we sort of like grew larger, we said, hey, I mean, we need to really insource a lot of that financial services expertise that is actually. You can consider traditional knowledge, but still, has proven to be effective and doesn't need to be reinvented. So I think our biggest challenge right now is actually to find people that have that bring sort of like financial services expertise, that know how to run risk and governance to some extent, how to deal with things like IFRS 9 and loan provisioning and so on, but have like the mindset that sort of like makes them compatible with a tech company. Mm-hmm. And we're based in Hamburg, Germany, so it's not, a big hub for financial services. So for us, it's really, really important actually to bring in people from all around the world. And we have been pretty successful lately in actually hiring people from London. I think Germans that moved there at some point and have an interest at some now, I think, to come back. And I think we're one of the biggest sponsors for Blue Cards. In Hamburg, actually, to bring in talent from.
Did you maybe explain what blue cards are? I don't know if the audience will be familiar with.
Yeah, so if you basically acquire talent, or if you want to hire people from outside the European Union, I think particular for with tech qualifications, there's a blue card process that basically empowers you that in a matter of a couple weeks, I mean, you can get, a respective work permit, and it's a very seamless process. So we actually think that's one of the things that, make the system very competitive for recruiting.
Yeah. Okay. We've got a few minutes left. We started off with a slightly sort of optimistic take. A lot of the kind of political uncertainties have been, or political tests have been passed, and there's a bit more good economic news around Europe at the moment, certainly compared to a year ago. But I'm going to ask you to finish on a pessimistic note, or at least I want to ask you what you think the sort of the roadblocks ahead are, whether they're political, economic, financial. What are your biggest concerns if you think about what the financial landscape is going to look like a year from now?
So clearly, I think everything that signals, uncertainty is harmful. In my point of view, I don't think that there are any major surprises to expect. I think from the regulatory environment. I think what would be very helpful for fintech is, to see actually a couple of larger scale exits. So I think there has been over the last couple of years, a lot of capital has been invested into fintech. I think valuations are still comparably high, and I think it's important. To keep fueling the industry. I think that a couple of larger companies actually manage to place successful exits or IPOs because it would eventually continue to fuel the entire ecosystem. So I would be very much looking forward to see some of that over the next couple months and years.
Okay, you very deftly managed to turn a question about pessimism into an optimistic answer.
I'm an optimist by nature. I'm an entrepreneur.
That's why you work for a tech firm. Josh,
let me do that. So I've been too long in a bank. It's all about risk and what happens. So I'll do. I think there are two things I would point out. One is that there's that story, isn't it, that a huge number of very innovative companies started in the 30s during the recession that was there. If you think about finance and two big businesses that drive revenue, one is lending, one is asset management. I'm not sure that a context of a very bullish asset management world and not that differentiated risk is the best context for differentiating the better from the less good models. So I think there's a real risk, actually slightly counterintuitively, that this rather sort of slightly deceptively benign economic environment doesn't allow the really good fintech winners to be weeded out from the less good for a period of time. And I think that is a risk because we want to work out some of these models aren't as good as others. I think the second thing, and I say this very clearly in Europe coming back, it's not a coincidence that the huge tech giants today have come out of the US, generally speaking, or out of China. We spent a lot of time with those. And we need to create stability for Europe to create scale. It's hard enough anyway because we're dealing with languages and the other areas. And we need to create the context and the framework within which Europe, and I say that in a very broad sense, can continue to allow businesses to scale and grow. And it may be better than a year ago, but certain things have happened that don't make that easier.
Such as?
Well, such as Brexit, such as the slightly unpredictability of what goes on in the US. Actually, the changing regulation in China as well. It's not a... If you're looking for stability, if you had the choice, you might say now, I'd rather go and operate out of one of these two very large markets. I'd rather start either in China or the US because at least I think I'm going to get a level of clarity in this very large home market.
Okay, and then just to finish off, we've got 1 minute left. Just on this sort of, where I'm based in Brussels, the mood is a lot lighter these days, and a lot of that is about the sort of the brighter, the better economic figures that we're seeing almost everywhere inside the Eurozone. I want to ask both of you, do you think that that is likely to continue, and what sort of opportunities does it present you? And you only have about 20 seconds to answer, so Alex, go ahead.
Well, I think now, across sort of like the, I would say the remaining European Union, I think, seeing a reinforced interest in Europe and hoping that at some point that actually sort of like boils down and sort of like a strong harmonization of like financial services regulation would be very beneficial. And I think there have been very little, truly European companies today in terms of offering a product which is not bound to one or two countries only, but made available across Europe. And I think, if we continue and if there's continued effort, to move beyond, I think, fragmented sort of like financial services regulation. I think it would be a huge benefit and would actually create a really, really big market for financial services that has not been seen in the world anywhere. So I really think that now this impulse of like positive economic development and sort of like a stronger sense of like, European affiliation is really used, to drive some of these initiatives going forward, and I think a lot of people will benefit from that.
Okay, Josh, last word.
Underlying economics, yes. Market prices, I have no idea.
All right, I think that finishes us off. Thank you very much indeed.
Thank you.
Thank you for listening. Cheers.
Thanks.
So I hope everybody had a good time. We've got one more talk coming up in a moment. I hope everybody had a great time in Madrid. I'm looking forward to welcoming you all to my hometown in Dublin next year. I've had a great amount of fun with MoneyConf over the last 3 years, and I'm really looking forward to doing what we do with conferences, which is basically blow them the fuck up. So we're just going to make MoneyConf very, very large next year in Dublin, and we're also going to run a small invite-only conference called, modeled on founders. So after Web Summit each year, we take the numbers down from about 55,000 down to just 200 people, 200 of, in my view, many of the leading, interesting, and most interesting companies in the world, and a handful of others. So we'll be doing that in Dublin this time next year, and some of you may come, some of you may not come. It's entirely up to you. The weather won't be great. It'll be pretty terrible in June in Ireland, but yeah. You may like to come, you may not, I don't mind. Anyway, from an innovation leader and source within one of Europe's largest banks, we hear what it takes to truly stay competitive and relevant as a bank in 2017. In conversation with the Financial Times, Laura Noonan, and closing MoneyConf 2017, please give a big welcome to the Group Executive Chairman of BBVA, Mr. Francisco González.
Good afternoon again. It's great to see so many people here for the end of the day. You've all made it. So now with us we have, I guess we can probably call him one of the kind of pioneers, I guess, of fintech within the European banking sector, certainly. And I guess his bank, BBVA, made an early decision to really put fintech and new technologies at the center of the strategy and to really aggressively try to become leaders in that space. So could you talk us through a little why you decided fintech and new technology was going to be so important to the bank?
Well, let me say, thank you for inviting me to this event, and let me say a few words about what we have done over the last years, because we began what we call the long digital journey 10 years ago.
10 years ago?
10 years ago. Taking decisions, specific decisions in terms of the foundations of the digital house we wanted to build up over time. The IT, the hardware, the platform, and so on. But in 2001, we realized that we needed to open our eyes and to see what was happening, in the ecosystem. And in 2012-13, we set up an office in San Francisco in order to scout the digital system. So many years ago, we realized that we alone were not able to go on in the digital journey without the help and the knowledge of the fintech companies. So we dedicate a lot of time and management efforts to understand the digital world and the fintech particularly.
So how much does it all cost? And was it hard to keep the investment and the focus going during the crisis, say, when there's a lot of demand on money? There must have been a temptation to cut back during tough years.
Sorry.
I
didn't hear you very well.
How expensive is it? And was it hard to keep the investment going during the crisis, say, when banks were making losses, there was a lot of pressure on costs? Was there a temptation to maybe pull back and say, we'll do this when things are better?
The sound resounds very much here, therefore I didn't got your question. Our strategy is based on three pillars: principles, people, and innovation. And principles is declined in basically three things. We can do everything, take every decision in the group, under three conditions. First, to be legal, which is obvious, and legal means not looking for loopholes. Second, to be publishable, to stand up to public scrutiny. And third, to be morally accepted in society. What did it mean? It meant that we didn't have haven't had any specific problem in terms of malpractices or in terms of cost-cutting whatsoever. So we started that strategy in 2007, and we continuously invested in this journey without any distraction. And that is very important because we gain time. Now everybody talks about digital change or so, but no, I was talking about digital for many years. Nobody paid attention to this phenomenon, and now everybody is in a hurry to jump into the bandwagon. But this is the best assets we have, time. And time means a lot of work has been done in terms of processes, in terms of corporate culture, management structure, customer innovation, so.
And then as well as time, I guess, there's also a financial investment to be made. How much do you guys spend on your various innovation projects and fintech investments every year, say?
We spend basically 2.5 billion euros per year.
Per year? 2.5 billion?
Yeah, but in order to both to run the bank and to change the bank. And run the bank is maintenance and opening of the branches every day.
Okay, so that's the kind of overall operating cost.
Yes, and changing the bank, which is innovations or so, is a big chunk of that money. Hundreds and hundreds of millions of euros every year. But spending money is not the most important thing. The most important thing is spending money in the right way. And we have made a lot of mistakes, you can imagine, in 10 years, but also we have learned a lot.
Can you tell us about some of those mistakes and what you've learned from them?
From the mistakes?
Yeah, and tell us about some like what you lost money on or what you wish you hadn't spent time on.
I think, I don't want to go into details, but the main message I want to convey is the most important thing to change an incumbent into a new company, in this case into a digital company, is to having the right management on board. That's the main thing. And we started this long digital journey with bankers, and over time we have to bring digitals, and over time we have to change our management team a couple of times over the last 10 years, and over time we have put in place an extraordinary management team which is a blend between digitals and bankers. And in fact, we are creating a new breed of professionals, bankers and digitals.
Kind of hybrid.
It's a hybrid, yes. But the good news for BBVA is that doing so and having such a sort of managers and processes or so takes a long time. Years,
Absolutely.
money, human efforts, and time. And so we are now ahead of the pack worldwide in terms of changing the banking system. And according to the number of customers we have in the digital world, customer experience also, we are really getting incredible experiences and really reaching our cruising speed in terms of delivering what we have invested in over the past years.
Because even with the very best people, there must be still some things that don't work out. And I think it would be really interesting for the audience just to get an example of something, without going into too much detail, but of something which didn't work or something that failed.
The most important thing I would say was we work on the platforms, the hard and the software platforms. And at the end of the day, we produce, I would say, a quite good car, the IT platform, the software platform. It's a sort of good Ferrari, okay?
Okay.
The big mistake was not paying attention to the other things. I mean, the engineers, the drivers, the roads, and the signals also. Turning the bank into a digital house is not just a question of platforms. It's a question of platforms plus a lot of things, which we didn't really discover 100% until 2008. 2011. At that period of time, we realized that everybody was focused on the platform, but nobody paid attention to the remaining things.
And are the other things all things within the bank, or are they things in the wider kind of financial ecosystem?
No, the main challenge was within the bank, because when you want to change an incumbent into a new company, of course, people don't like change, and people don't like to go out of their comfort zone. So it's very difficult to move an elephant like BBA, which has now 140,000 people.
That's a lot of people.
That is the main problem. The second, they weren't, and they are not even today solutions outside our bank. Some solutions are available, but the main core, which is the platform, the IP frameworks, has to be built up by ourselves.
By yourselves, yeah.
So, having said that, the threat of our strategy is not to make things which are available out there. If something is available, we buy it and we ensemble into our systems. But having said that, we have to work within the bank with a lot of resources, because nobody was delivering what we were asking for.
Because now you have a lot of different ways of doing fintech. You have what you develop internally, you have partnerships, you have investments, you have equity stakes in, say, Atom Bank, which we had earlier. So how do they all fit together?
Yeah, well, the first thing we learned is trying to change an incumbent, putting pieces outside the bank. It doesn't work. It doesn't work. In fact, we launched a digital bank, online bank, in 2000, and we realized that it doesn't work. You have to change from inside.
Okay.
That's the first message, and that's a very important message, by the way. You have to start from inside. As soon as you start from inside and you start to learn a lot of things, and that is what we have done, you start to first to scout the ecosystem and to buy pieces. In order to buy pieces, in our case, we have several ways. One is, for example, Open Talent, which is the biggest fintech event in the world, and that is the first approach to very, very early stage companies.
Okay.
The second approach is to buy smaller stakes in companies who have 2 or 3, 4 years of existence. The third is to buy out companies, entire companies, like we have done with Simple or Madiba in several parts of the value chain. And the fourth is to create startups within the bank. We also create startups within the bank which compete with their peers, their colleagues in this case.
And when you think about that whole portfolio, do you aim to monetize that someday? I mean, like, are you able to say, across all of those different types of investments, we have spent 2 billion, and if we sold them all tomorrow, we get 2.5 billion back? Or is that something that you think about, if you can get back what you invested in those companies?
Of course, we need to earn money because we are a private company.
As shareholders?
That's for granted, but earning money has different ways. Fortunately, BBA is a very sound bank with a very, very, I would say, robust business model, and we produce money every quarter. We have to deliver every quarter. At the same time, we're investing in those fintechs and buying options everywhere. And when we buy something, of course, we have a specific business model in order to earn money. But that is not the first motive. The first motive is to learn and to leave those companies to deploy their business model and to see how they are delivering. And at the end of the day, all those pieces have to be assembled probably in one piece over time. At the end of the day, what's going to happen? At the end of the day, what will the banking system look like? In our view, it's going to be a complete league of competitors made up of PVA and a few more physical banks able to turn into digital houses. Some big giants of the net, definitely, over time, and probably some startups. No, not many. Most of the startups will go bust. Most of the banking conventional banks will go bust. Most.
Why do you think they'll go bust?
Will bust because banks won't have the time or the money, probably the time to convert, to turn into digital houses. They will live in a world digital world, which will work with very, very, very narrow margins, with extreme transparency and lack of conflict of interest.
Okay, so they can't get big enough to tolerate the cycle.
You have to be big enough, and big enough means, in our case, hundreds of millions of customers. Now we have 65, 68 million customers. We will need hundreds of millions of customers in order to offset lower margins and to gain the trust of our customers. So this is a league which is going to be made up of by few players.
And when you think about the other people like yourself, the other men running the biggest banks in the world, do they get this now? Because you were saying that early on people didn't really know why you were going so digital. Is there a dawning kind of realization, yes, we need to do this too?
Today every bank, I'm talking about the big guys or the medium big guys, the 31st banks in the world, 40. Everybody is talking about digital transformation. Some of them are putting some resources, but most of them, not all, but most of them are not putting the digital strategy at the top. In our case, the digital strategy
starts with you.
Starts from me, and you need a strong leadership and determination and time to convince everybody that you are in the right way. Now, I don't have any problem with that. Everybody understands this strategy. So my view is that banks are working on that, but most of them won't be able to get rid of their legacies. In terms of legacies means not just the equipment, the platforms, which are what people say spaghetti platforms. They won't be able to get rid of those platforms very soon. They think that they have a lot of time, and my view is that change will happen sooner than people think. In 5 years from now, the digital bank, the banking system is going to be not completely digital, but it's going to be completely different. In our case, we today sell our products through digital channels. 24% of our sales are done through digital channels. 24. 1 year ago was half. 3 years ago was 8%.
So how far
80% in 5 years.
How far off are we from having a world without bank branches?
Sorry?
How far away are we from having no more bank branches?
Branches. There will be physical branches for many years. The real thing is the ratio between branches and number of customers will be completely different. Now a branch can attend 5,000 customers. In the future, it's going to be 30,000, 40,000, 50,000. I don't know.
So you have far fewer branches.
Probably fewer branches. On the other hand, there will be more customers because there are 2 billion people who are out of the banking system, and they will sign up for the banking system. But fewer branches.
Like here,
and the role,
you have fewer.
Yeah, and the role of the branches is going to be completely different. Transaction, for example, in our case, 85% of the transactions are made through digital channels. So branches will be a place where people will meet with our people in order to talking about real value-added products.
Because you've already made some pretty big cuts to your branch network.
Oh?
You've already cut back branches a lot in the last 10
Closed down.
years. Yeah.
We have, in Spain, we have closed down 20-something% of our network. But we will adapt our network smoothly over the next years. And I don't think any big movement in terms of closing down our branches in Spain. In the rest of the country, we are not closing down branches. The number of branches is okay. What we are putting is a lot of more customers, under the leadership of any branch. More customers per branch.
I'm glad that you brought up the more customers, because with the day that's in it, we couldn't let it go without asking you about a big opportunity to get more customers. If you guys had bought Banco Popular, you would have a lot more customers. What did you think of the deal, and why didn't BBVA participate?
First of all, good news from the economic point of view that there was a problem in the system, and that problem was fixed. Good news. And that proved that the Spanish banking system was robust enough to fix the problem without public aid. The first time in Europe, probably in the world, that one bank is resolute, is going to a resolution process without public aid.
Yeah.
That was done last night and the bank was acquired by Santander. Good news. In our case, we have a completely different approach. Our approach is to turn the bank into a digital house. So when we look at physical assets like Popular is, you can imagine we are extremely demanding in terms of price. In terms of pricing, we are extremely demandant. So this, I think you can more or less have the answer.
But you are going to have, I mean, in terms of the competitive market within Spain now, you'll have a very big competitor. How does that change the landscape? Because when you put those two together...
Well, of course, Santander will be the first bank in Spain in terms of assets, but at the end of the day, you have to be the first bank in terms of customer satisfaction and digital transformation. And that is the real thing. I don't believe that physical banks have a bright future, frankly. I don't believe in the conventional physical banks anymore. I think if you haven't worked a lot in terms of transformation today, you won't be able to catch up. You will have a lot of troubles in order to compete over the next 5-10 years in the banking system. So, in our case, we are very happy today.
Okay, I think that's probably a good note to leave it on. Thank you guys all so much for listening and being such an attentive audience. Thank you, Mr. Gonzalez, so much for your time. Okay. And I think that brings this session to a close anyway. Thank you.
Thank you. Thank you.